So let's go ahead and start with the bare basics, all right? We're going to tailor this lesson around day trading options, right? Tomorrow we will add to it and we will talk about swing trading options, right? There's a couple things that you could look for, right? Like for instance, write this down. If you're day trading an option, when you day trade, what's your typical hold time on a day trade? 10 to 20 minutes, right? I personally don't like holding a day trade more than 5 to 10 minutes. Sometimes I do end up having a trade that lasts 20, 30, but it's rare. So on average, when I'm taking any kind of day trade, I expect to see the move happen in a short amount of time, right? Again, maybe 10 to 20 minutes. So let's think about that when it comes to options, all right? If you're going to be day trading options, it's probably the same techniques and the same strategies. Again, you kind of look for that play to work itself out in about 10 to 20 minutes. So I want to talk about one term today, and that's going to be theta. Theta, guys, Theta, is a Greek, all right? Theta is a Greek, and what theta is time decay. So that means, right, let's use RKT as an example, all right? So we're going to use RKT as an example. If you come in here and buy one of these call options, all right? So a call, you expect the price to go up, right? To keep it simple. You buy a call, you want the price to go up. If you buy a put, you want the stock's price to go down. All right, so let's say, hypothetically, that we want to buy call options on RKT as a day trade. Let's say we have a strategy in front of us. Let's say we have an opportunity, right? And we want to day trade a quick move here on RKT. All right? So let's say you come into your options chain and you're like, you know what? I'm going to buy this $18 strike. All right? You're going to pay 0.35, right? That's going to be $35 per contract, right? So if you come in here and you're like, you know what? I think RKT is going to go up $1, right? Let's say that's your trade. You come in here, you buy an $18 strike contract call because, again, you expect the price to go up. And right now it's going to cost you $35. So hypothetically speaking, if RKT doesn't move a penny, it sits at 1768 all day, you're going to lose money. And you're probably thinking like, what do you mean I'm going to lose money, right? The price didn't go up. The price didn't go down. So you would think the option would retain its value. It would stay right around that 35 cents. Well, you have something called theta. Theta is time decay. So hypothetically speaking, you buy this option for $35 and RKT sits here at 1766 all day and doesn't move. It's just stagnant. There's no volume. There's nothing going on. Your contract will lose value based on the theta, the time decay, right? So we can see here that just by you holding this all day today, you'll lose approximately $5 per contract, right? So if RKT does nothing, at the end of the day, this contract will probably be worth around $30, right? You'll probably lose about $5 from the time decay. So that's theta. So I want to talk about theta, right? Again, when we're day trading these plays, when we're day trading options, we expect something to happen within 5, 10, 20 minutes, right? So with that being said, the theta doesn't really play that big of a factor, right? You may see a little bit of time decay, but it's not going to be substantial. And I want to point this out on an example like Tesla. When I first started trading options, I never traded Tesla. Why? Because I always saw the theta, right? Number one, they're fucking expensive. They're very expensive. But regardless of the price, I was always deterred from trading Tesla because of the theta until I learned that, hey, I'm day trading Tesla, right? I see a move. I want to take it for about 10 minutes, right? I think Tesla's going to move $2 in 10 minutes, right? I wouldn't trade Tesla because I was like, man, I'm going to lose a lot of money in theta until I realized that my trade was so short in time that the theta really made no impact on the value of the option. So when we're day trading options, guys, is it important to look at the theta? Yeah, it's important to be mindful of theta, okay? But again, if you're expecting like a quick in and out trade, 10 to 20 minutes, the theta is not going to make a substantial impact on your P&L, right? Your profit. You're not going to lose a lot of value on the option for 10 to 20 minutes of a trade. Now, if you start holding it an hour, 2 hours, 3 hours into lunch, into the end of the day from the morning, that's when you need to really be concerned about the theta. So theta, once again, is time decay. If you expect to day trade an option, right? In and out 10, 20 minutes, the theta is not going to make that big of an impact on the value of your option, okay? What's the one thing that we really need to be focused on when looking at options, right? To help determine our risk reward, right? Because just like trading stocks, we need to have stop losses in place. We need to have profit targets. We know our entries, we know our setups. We still have to build our plans. The only thing we're doing now is we're trading an options contract, not the actual share. So how do we actually determine what our potential risk would be and our potential reward would be based on the option? We're not taking shares, right? I know if I bought 100 shares of Tesla at 640, and if it goes up to 645, I know that I'll make $500, right? I'm buying 100 shares at 640. It goes up $5 per share. I would make $500, right? I can assess my risk. If it comes down to 638, I'm going to sell. That means I'll lose $200. Shares are really, really easy to build a plan, right? You know how much the stock goes up or down per share and what your loss is going to be. It's a little bit different with an option. So how do we still determine, our risk reward, what our profit target will be in the far as dollar amounts, what our risk is going to be in regards to dollar amounts? How do we do that? Well, that is delta, guys. All right. So the delta is the change of the option per dollar move. So right now, we look at Tesla, right? If Tesla goes from 641 to 642, this option will most likely increase approximately $50 per contract because the delta is 0.50. So the delta is for every dollar Tesla goes up, for every dollar Tesla goes down, you will make or lose $50 per contract that you hold. Okay? So that's how you're going to determine what your risk may be. Let's find something that doesn't have a super expensive options contract. All right? Let's go look at Apple, for example. Let's look at Apple. All right? So look, same thing. We have your delta and your theta. The thetas are smaller than they were on Tesla, right? But again, we know that if we're day trading these and the trade's going to be quick, the theta doesn't make that big of an impact. We really need to be focused on delta. So let's say you come into here and you're like, you know what? I think Apple's going to go up, right? I think Apple's going to go up $1, right? So you think Apple's going to go up $1. So that means if you buy one of these contracts that have a 43 delta, if Apple goes up $1, your option should go up about $43 in value. So now how do you assess your risk? How do you determine what your risk is? Well, divide the delta. That's it. So for every dollar that Apple goes up, you're making $43 if you buy a 129 strike. So if you're looking at the chart, you can say, all right, Josh, you know what? I'm in at 128.25, right? That's my entry. That green line's my entry. All right. And you're saying, I think it could go all the way here to this purple line, all right, which is my profit target. So let's say hypothetically I'm long at 128.25. And I think Apple, within the next 10, 20, 30 minutes, right, short time, can get all the way up to that 129.25. That means that if I bought one of these 129 contracts for $120, I would probably be able to sell it for about $160 because the delta is 43. That means $43 is what I would make if Apple gets that nice move up to 129.25 in a short period of time. But what if it takes all freaking day, right? Well, that's when the theta comes into play. So if it takes all day, subtract your theta from the delta. Give you a roundabout, right? If it takes all day to get that dollar move, your option is going to be devalued because of theta. So you're not going to make as much. You'll still be profitable, but it won't be the full $43 because now you have your theta decaying the value of your options contract. All right. And then like Matt said, we're definitely going to talk about spread. So spread is something I definitely have on there as well. And then, what price of options to trade, right? Implied volatility, all of these things, right? The average trading range of a stock. Right now, I was talking to Matt a couple weeks ago, and it's like, we can't even trade Apple now. Apple trades 25, 30, 40, 50 cents, right? It doesn't really trade those $2 to $3 moves that it did before the split. So Apple is one of those really, really, right now, difficult options to trade because if you find an entry here, right? Okay, I want to buy at 128. It's fucking taking 30 minutes to move 50 cents. Well, before the split, Apple would move $1, $2 at a time. So another thing to write down is find a stock that on average trades $2, right? Its average trading range is $2, right? That's a good rule of thumb. It doesn't have to be. That's one of my rules, right? When I'm looking at a stock, I want to see that on average, it moves roughly $2 a day. That shows me that I can actually make decent money on the option. Apple's pretty hard because, again, it moves maybe 50 cents to 25 cents, 75, maybe if it's having a good day, $1, and it takes forever, all right? So again, the average trading range, all right, my rule of thumb is around $2. I want to see the stock have an average trading range day after day after day around $2. Another rule of mine is the spreads should be no more than 5%. That's my personal rule, all right? So if I'm looking at an option to trade and the spread is more than 5%, I will not trade it. Your rule could be 10%. Your rule could be 15%. You have to determine your rule. And now the spread is going to be the difference between the bid and the ask. So when you want to buy an option, guys, you're going to get filled on the high end, right? So right now, if I bought this call on Apple, I'm getting filled at 127, not at 125 unless I put a bid in. But if I want to get in right away, right, you can market order in, or if you send an order out on the ask and you buy the ask, you're getting filled at 126. Let's say Apple had a 10% spread. That means the ask would be at 126, okay, and the bid would be at, say, like 115. That means the second you buy Apple, hypothetically, you're buying it at 126, and let's say the bid is at 115. Immediately, you're down $10 a contract. Let's say you bought 10 contracts. You're immediately down $100 because the spread was 10%, right? So again, spread is very, very important. Just because you think a stock's going to move, you need to look at spread. Look at this, for example. Let's go look at something that has a really bad spread. So look at this. PTE has an options chain, all right? PTE, for some crazy reason, a dollar stock has an options chain. Why would you not want to trade these options? Well, number one, you can see that there's no volume, all right? So volume is very, very important. If we add volume here, let's go ahead and customize and add volume. We can see that there's just no volume on these options. That means that no one has a freaking interest to get in or get out of these, right? Volume, 10 contracts were traded today on the $5 strike. So you probably got a newbie coming in saying, you know what, I'm going to buy $50 worth of freaking PTE's options because maybe it goes to $5. Again, this is not an options chain that you want to trade. So another rule is, again, the price range of stock. My rule is probably like $100 to $400, right? Anywhere from $100, $150, $400. That's going to give you an affordable option, good spreads, everything like that. The higher the price, the stock, the higher it costs, the bigger the spreads. Like, look at Tesla. Tesla's a $645 stock, right? The spread here is actually not bad on Tesla, but the price is very, very expensive, right? The spread's not bad at all, but they're very, very expensive. Sometimes what we see on some of these expensive stocks is not only are the options expensive, but the spreads are large. I remember Tesla, when it was very volatile, the spreads were about $2 between the bid and the ask. I'm curious on Netflix. Let's see if Netflix usually has a pretty large spread. Let's see if Netflix has a large spread today. So, I mean, the spreads aren't terrible, right? So, I mean, right here, 10% of 560s 56, 5% would be roughly $25. We can see the spreads right about 30. So the spreads are still pretty large on Netflix. Look, if you wanted to buy Netflix right now, you're paying $560 per contract. If you sell it right away, you're selling it for $525. You're immediately down $35. Right? So again, spread's very, very important. Netflix usually has a decently large spread of 5 to 10%. Again, when Tesla was very volatile, before it split trading like $1,200, $1,300, $1,400 a share, not only were these $2, $3, $4 grand a contract, but the spreads were like $100 to $200, right? The spreads were like 10%, guys. So again, spread's important. My rule of thumb is 5% spread, all right? 5% on the spread is my rule of thumb. Number two, stocks between $1 to $400. Why? The spreads are usually tighter, number one, okay? And on top of that, they're going to be less expensive to buy, right? So again, look at Facebook. Facebook is a $300 stock. If you wanted to find something here that had a 30 delta, you're going to pay $200 a contract. That's not bad, right? That's not bad at all, right? You go look at Apple. Apple's a $128 stock. You want to come in here and buy one that has a 30 delta? All right, you're going to pay $85 a contract. Not bad at all, right? But you come into Tesla. Tesla's a $650 stock. You want to buy something that has a 30 delta, you're paying $1,000 a contract. Those are expensive. So again, if If you find yourself in that range of about $100 to $300, maybe $400 on the actual price of the stock, the options aren't going to be too expensive, okay? So again, anywhere from like $100 to $400, you're going to be able to find an option that you can actually get involved with for like $100 to $200 that still has a decent delta to where you can actually see some returns, right? And like Beth said, the SPY usually has some very tight spreads and very cheap contracts as well. And the really nice thing about the SPY is you have an expiration date 3 days of the week, right? So you have a Monday expiration, a Wednesday expiration, and a Friday expiration. The S&P is the only thing that has 3 expiration dates a week, right? So by having 3 expiration dates per week, it brings the value of these options down. And again, if you're like the day of, let's say you're trading the day of, this expires tonight at 4 o'clock market close, right? These are dirt cheap. You're paying for an at the money call, right? These are right at the money. You're only paying $30 a contract. If the SPY goes up $1, you'll make about 100% return on your money, all right? So again, the really nice thing about SPY is, yeah, like Beth was saying, the spreads are really, really good, right? The spreads are nice and tight. They have 3 different expiration dates during the week. You have a Monday expiration, a Wednesday expiration, and a Friday expiration. Why is that beneficial? Because if you're trading the SPY on a contract that expires today as a day trade, if the stock moves in your favor, you can make a lot of money. If the SPY right now were to go from 422 to 423, you would make 100% return on your money. You're buying one option for $30. The delta is 30. So if the S&P goes up $1, all right, you're going to make $30 a contract and you're paying $30 for the contract. You're going to make 100% return. So again, the closer to expiration you are, the bigger the returns and the quicker the returns that you can see. All right, so I just want to clarify that. Because we're talking day trading today, not swing trading. I don't want to jump the gun and get off track. So again, the closest to expiration is what you want to day trade. Personal preference, okay? If you know you're in and out today, you're in and out within the next 20, 30 minutes, I recommend trading the closest to expiration because that is going to give you the biggest returns, right? You're going to see these increase in value much faster than what you're going to see a further out till expiration increase. Not only that, all right, they're going to be a lot less expensive. So for example, if you're going to day trade Boeing and you think you're going to be in and out within 10 minutes, you can buy a 240 strike for $278. But let's say you didn't know, hey, I can day trade these 4 day till expirations, right? And pay $273 and I can still make the same amount of money. Come down here. You're going to pay $755. So from a reward standpoint, yeah, your delta is still around 40, right? So if you buy a 4 day until expiration call on Boeing and it goes up $1, on the 4 day until expiration, you make $40 a contract. All right, let's put that in perspective of percentage. All right, you're paying $260 and you're going to make $40. So times 0.20. You're going to make about 15% return, right? You're going to make about 15% return. If you buy a Boeing call at $265, it goes up $1 and you make $40. That's about 15%. Let's go down here. If Boeing goes up $1, you're still making $40 a contract, but you're having to fork up more capital ahead of time. You're forking up almost 3 times as much. So now take that 15% and divide it by 3. You're no longer making 15% return. You're making 5% return because it's costing you a lot more money to go ahead and buy that contract. So again, it's okay to day trade, right? To trade close to expiration contracts because you're going to spend a lot less money. So that means you can buy more contracts. And you're still going to have a good return if the stock moves in your favor, say $1, right? You would make about $40 per contract, which is about 15%, versus going out 25 days and only making 5% return on your money, all right? So again, this only applies to day trading. You're in and out within 10, 20, 30 minutes. Or if you want to swing trade, if you think you're going to hold it all day, maybe into tomorrow, don't buy the closest to expiration. Maybe go out a little bit, reduce your theta, right? Pay a little bit more, but they're not going to move as aggressively, right? Again, your theta here is 37, your theta here is 23. So time decay alone, you're already saving about $15 per contract just for holding it into the next day. So again, that's when we get into our swing trading options tomorrow. That's when the theta really plays a huge factor, okay? So I lost my train of thought. So again, you can day trade the closest to expiration contracts. It's going to cost you the least amount of money. You're still going to have great returns because the deltas are still $30 and $40 per contract, which equates to higher percentage returns trading these close to expiration contracts, and they're less expensive as well. So let's go ahead and recap real quick before we move on. So number one, identify a set of stocks that move, $2 a day on average. All right. So number one, find a list of stocks that move on average $2 per day. All right. That could be Boeing, that could be Tesla, that could be Snapchat. Really just dive into some of your favorite stocks that move, that normally have some volatility, and identify a list of stocks that on average move $2 per day, right? Because that's when you can actually see some reward trading options. All right. Number two, find stocks that are around $100 to $400 in price. Why? Well, number one, the spreads, right? So if you find a stock that trades on average $2 a day and it's valued of around $100 to $400, number one, the spread normally are a little bit tighter, all right? Right, on average, not 100% of the time, but normally the spreads are going to be tighter. They're going to be less expensive. All right, and they're going to be less expensive. So the spreads and the price, right? We saw a Tesla example, $600 stock, $1,700 contracts. We go to Boeing, right? $240 stock. You can buy an at-the-money call for $200 instead of $1,700. So not only are they less expensive, we see the spreads are a lot tighter as well. Again, we had a nice example on Netflix. Looking at Netflix, they're about $500 and their spread is pretty large. Look at their spread and an at-the-money call, right? That's about 10% right now. That's extreme. You buy one at $560 and you sell it right away, you're selling it for $515. You're immediately down $45. So again, this Netflix options, their spreads are normally large. They have high thetas, blah, 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 blah. All right, they're a more expensive stock, right? Again, they're about $500 a share. Their spreads are typically 5 to 10% on average. Netflix, in my opinion, is hard to trade because of the spreads. The second I buy a Netflix call, I'm immediately down. So you got to really time these right. You got to be able to take the heat. And again, as a newer trader, this is something that you should back test and see if, that 5% rule is okay. Can you go to a 10% rule? Again, have a rule of a certain percentage on spreads. My rule is 5%, right? If you back test and you find an edge and you have a strategy and you can do 10%, as long as it doesn't, increase your loss or go against your plan of, 2 to 3% of your account on a single trade, everything like that, then that's okay. But my rule of thumb is only trade options that have less than a 5% spread. So let's go ahead and review those one more time. Number one, a stock that trades on average $2 a day. Every day on average, it trades roughly $2. Number two, find stocks that are valued around $100 to $400. That's going to help reduce the spread. It's going to make them less expensive as well. Okay, number three, find spreads, right? Do not trade an option that has more spread than 5%. That's my rule of thumb. Okay, so if the spread is more than 5%, don't trade it. So example, Netflix, right, falls outside of that $400 price range. The spread is 10%, all right? On average, we can see that some of these spreads are about 10 to 15%. Some are 5, but on average, we're looking at these, like the 479.5 is almost $1 a spread. That's almost 20%. So is Netflix something that would meet that criteria? For a newer trader, again, we're talking to you guys that want education on options, that don't really actively trade them all the time. Would we really want to trade Netflix calls and puts? No, because the spreads are too aggressive and you'll be taken out very, very quickly and immediately down on your trade. And that's something that you don't want to do. So example, you would want to find something like Boeing, right? Boeing meets criteria number one, trades $2 on average. Meets criteria number two, it's between that $100 to $400 price mark. It's $237. The options are less expensive, right? You can buy one for $200 and the spreads are 3 cents, right? 3 cents. The spread is literally 2%, 1%. So it meets that criteria. On the spreads, they're not expensive. The spreads are tight. Trades on average $2. So Boeing would meet that criteria of something that you could add to your options watch list and trade this actively, right? Because you already know the spreads are going to be tight. They're not going to cost you an arm and a leg, all right? So that's kind of my checklist of what I go through, right? When it comes to average trading range, the spread percentage, the price of the stock, all of that good stuff. So now let's take all of this information and talk about how we can incorporate this into a strategy and how you can manage your risk, okay? And we keep it very, very simple. We still analyze the charts, guys, right? We still analyze the charts. Let me go ahead and remove some of this. And let's have a clean chart and use Boeing as a hypothetical example. So right now we can see here we have support off this low right around 237. Let's say you think this is an inverse head and shoulders pattern. Let's say you're like, Josh, I see an inverse head and shoulders pattern on Boeing. It sold off, it bounced, lower low, bounced, trying to form this higher low right here. And it looks like we may have this possible neckline for a possible reversal on Boeing. So you can sit here and analyze your setup. You can say, okay, I'm making my entries right here at 237.48. This red line is my stop loss, and this purple line is my target. So right here, you've already built your plan, right? You've already built your plan. Green is the entry, red is stop. Target 238.63. So now you say, okay, I have $1 potential to the upside. I have 50 cents until I'm stopped out. Now, how do we build this into a plan? How do we actually incorporate this into an option? So here we go. We know that we're expecting $1 reward, and we're going to stop out when the stock comes down 50 cents in price. What does that equate to on an option? So let's say we come in here and we're going to buy a 370 call. All right. So first thing we want to look at, or I'm sorry, not a 370 call, a 237.5 call. It's going to cost us $365 to buy it, hypothetically. All right. So right now we're in at 370. So that is $370. The delta is 51, right? So if Boeing comes down 50 cents, how much will we lose on that option? So again, hypothetically, we're in, right? We're in right now on a 237.5 call. We're in, right? We just paid $370 for it, all right? If Boeing comes down to 237 and I sell my option, how much will I lose? Someone give me an answer that's been paying attention. We already talked about delta, right? And we will talk about volume here in a second and open interest, okay? So again, just for this example of the purpose of assessing your risk before taking a trade, how much will I lose if I'm stopped out, right? It's not as easy as a share. It is easy, but it's not as easy as share, right? I know if I buy 100 shares and it comes down 50 cents, I'm going to lose $50, right? I know what that is for the share, but how do we do that with an option, right? Again, we look at delta. So we know that if Boeing goes up $1, we will make roughly $50 per contract, right? If Boeing comes down $1, we will lose roughly $50 per contract, right? So if Boeing comes down 50 cents and we're stopped out, how much would we probably lose on that option if Boeing comes down 50 cents from our entry? I'm waiting for someone to give me an answer. Someone that's listening, someone that's paying attention, right? Simple math here, guys. If Boeing goes up $1 from our entry, we're making $50 a contract. If Boeing goes down $1 from our entry, we're losing $50 a contract because, again, the delta is per dollar move. So if Boeing comes down 50 cents and hits our stop level, how much would we lose on that contract? Anyone? Anyone? I'll give you guys a couple seconds. Looking for an answer here, guys. Again, I want to make sure you're all on the same page. You understand how the delta works per dollar move. And again, I want to see who's listening. How much would you probably lose on that trade, guys? Again, we bought it for $370, right? That was our entry, $370. Okay? Our stop loss based on the chart was 50 cents. So all we're going to do is divide the delta in half, right? Because again, per dollar move. So if we come down 50 cents, we'll probably lose half the delta, which is $25. We just got stopped out. Right now, we stopped out at $330. All right? So we just stopped out at $330. We just took a $40 loss. Okay? So again, that's how you're going to be able to, number one, assess your contract size, assess your risk, and accept your risk. Okay? You still identify setups based on the chart. We all know that. Where's my entry? Where's my target? Where's my stop loss? You still build your plan. You still analyze, right? And you still assess the 3 A's. Analyze the chart, assess everything, your entries, your stop losses, your targets, assess your risk, how much are you willing to lose on the trade? You take all of that data, all of that information from your plan, and you overlay that on the options chain, right? So coming into it, Josh, if I buy one contract at 237.50 and it stops me out at 237, I'm losing 50 cents on Boeing. Now, if I buy a 237.5 options contract, a call, I will lose approximately half the delta. The delta is $50 per dollar move, right? It goes down 50 cents. I will lose about $25 per contract if I'm stopped out. If I hit target, I will make about $50 per contract if Boeing goes up $1. So just like that, you still do what you do best. Yeah, analyze, you assess, and you accept. Analyze the chart, assess your risk, and accept your risk, right? You're still building your plans, guys. Then you just go look at the option. You're like, okay, well, let's say hypothetically, you're like, well, you know what? That delta would be giving me too much risk, right? I can't lose that much, right? Because if I lose 50 cents, that's 25. That's too much. I need to be right about $15 on this trade, right? If it comes down 50 cents, my stop loss needs to be no more than $15 a contract. What does that mean you have to do? You can't buy the strike that has a 50 delta, because if you get stopped out, you're losing $25. You just told yourself you can't lose more than $15 a contract on that trade. So what does that mean you have to do? You have to reduce the delta. You have to go to a different strike, right? So that means you'd be like, you know what? I'm taking too much loss on this 237.5 strike. All right, because if I'm stopped out, I'm losing $25, give or take. Come down here, right? I'm still taking on a little too much. I'm losing about $20. Here we go. Look at this. I could buy a 242.5, and if I'm stopped out at that 50 cents, I'll lose about $15 a contract. You see what I just did there? I analyzed the chart. I assessed my entry, my profit target, my stop loss area, and I knew what I was okay with losing, right? $15 a contract. And now because I know what the delta represents, I know that I can't buy a 237.5 strike. I can't buy a 240 strike. I would have to buy a 242.5 strike just in case I'm stopped out. I'm not exceeding my loss, right? Again, delta is very, very important, guys. If I want you to take anything away from this, delta, delta, delta. Delta is how much you're going to make or lose for every dollar the stock goes up or down. Okay? So again, that's how you're going to actually build a plan when it comes to options. It's that easy, guys. You still do what you do best on the chart, right? You still do your technical analysis. You identify everything, where your stop's going to be, where your target's going to be. You take that data, right? That dollar target, 50 cent stop. You take that data, and now you come look at your options chain. And you make sure you're not going to exceed your loss, how much you're okay with losing. Again, it takes a little bit more time, right? Because you're doing a little bit more math. You have to calculate the delta, 50 cents, right? Divided by blah, blah. It takes a little bit more time, but once you get the hang of it, you'll be able to jump right into an options contract, know exactly which one you're going to buy, what your risk is, what your reward is, how many contracts you're buying, what that equates to. You'll be able to look at the spread, right? You'll be able to get the hang of it faster. So in the beginning, it is a little bit complicated because there's a little bit more math. It's not like I'm buying 100 shares of Boeing and at 50 cents, that's a $50 loss. Boom, that's it, done, right? Now you got to take that data and go say, okay, what's the delta? How much is it? What's the spread? You got to do a little bit more math. So it does make it a little bit more complicated until, again, you get some momentum behind it. Now, next, Matt brought up a couple great points. He's jumping the gun on me, Matt. No, I'm kidding, Matt. But again, we are going to dive into volume and open interest, okay? To keep it super, super easy, trade which one has the most volume, all right? For example, that 237.5 has 4,000 contracts traded today, right? Now, could you get in and out of that? You could get in and out of that contract, but the spread with low volume, all right? Keep that in mind. The lighter the volume, typically the more spread there's going to be. That's not always 100%, but I've noticed that over my trading career. Right? If you have a strike that has substantial volume, so like this one here has 44,000 contracts being traded. You see the spread's 3 cents. You come here, You see the volume's 4,000. The spread is about 15 cents. You see how the volume assists the spread? All right, now look at this one. Again, it's not 100% of the time. This is something I've noticed. This one, the spread's not too bad. It's only trading 3,000 contracts a day and the spread's 2 cents. So again, just as a rule of thumb, guys, is if you're starting to get aggressive with options, right? Let's say you're trading a $100 stock that really doesn't usually have a lot of options action, but there's a day that it does, hypothetically speaking, right? You want to be mindful of the volume, or if you start becoming more aggressive with your size, right? The last thing you want to do is buy 100 contracts when the volume's like 200 for the day on that particular strike. You may not be able to get out, right? There's not a lot of interest in that strike. So again, before getting involved in buying options, because I'm sure you're going to go out there and dabble with, penny stock options. I'm sure you're going to do, you're going to go out there and you're going to get your feet wet. You're going to test around, right? But always, always, always look at the volume, right? Try to trade the option strike that has the most amount of volume. So from my example, we were looking at the 237.5. Look at the volume. It's only 4,000. Now, is that terrible? No. If you bought a contract, could you get in and out? Yes. You can get in and out very easy on one contract. Could you get in and out easy on 100 contracts? Yeah, right? You have enough liquidity. You have enough people trading these to be able to get in and out. But again, why do we say volume? You need to look at it. Because again, you're probably going to go out of interest and you're going to dabble with some other stocks, right? And the last thing you want to do is say, you know what? I'm going to buy PTE calls. I'm going to buy 1,000 of them, right? Because they're so cheap. I'm going to buy 1,000 and you're in. And you can never get out because there's no volume on them. So again, just be mindful of the volume, all right? For this example, we were doing the 237.5 strike. Your best bet, honestly, just for the safety, the security of being able to get in and out easy, and honestly, it does help tighten that spread up as well because you have more buyers and sellers. Think of it, liquidity, right? Think of it like a penny stock. When you don't have a lot of buyers and sellers, you don't have a lot of volume, what happens to the spread? It opens up, right? When there's no liquidity, there's no volume, you have a lack of buyers and sellers on a penny stock, what happens? The spread is large. But let's say you have a hot penny stock, there's a lot of volume, right? There's a lot of activity, there's a lot of liquidity, everybody wants to get involved, right? There's more volume. The spreads are typically tight, right? A penny, 2 pennies, 3 pennies. So same concept, right? The more volume, the more interest we have, the tighter the spreads are going to be because the more participants you have buying and selling, buying and selling, buying and selling. So those spreads between bid and ask are going to be closer together. When you have light volume, you have light interest. There's not a lot of liquidity with the option. That's going to open the spreads up, which is going to make it more challenging to get in and get out without taking a lot of slippage, without taking a lot of heat based on the spread. Okay? So, with that being said, guys, do you have any questions? I know we went through a lot, right? We really broke this down, the delta, how you build your plans, how you actually build a plan on top of the delta. You can actually go close to expiration on these contracts, pay a little bit less, still see some really nice reward as far as profits when it comes to percentages, right? Again, you go a 4-day out on Boeing. We did that example. You're making about 15, 20%. If you go 3 weeks out, you're only making 5% because they cost more money. And it's okay. There's a bad rep with day trading, close to expiration options. People used to give me crap all the time. I'm like, I do good with that. Matt does good with that. Matt trades close to expiration options and he makes 6 figures a year. Why? Because he understands what he's getting involved with. He understands that you can trade these, right? You can trade them. They're just less money. And you got to make sure you're on the right side. And you got to manage your risk. The last thing you want to do with a 4-day till expiration contract is take the trade, be on the wrong side, and stay on the wrong side of the trade, not honoring your stop, back holding that option. That's when it gets scary. That's why close to expiration options have a bad name, because if you took that trade on Boeing, guys, the hypothetical trade that we just went over, and you haven't cut your loss yet, let's say you don't cut your loss and it continues the dump. You hold it until tomorrow and it continues the dump, right? It's going to lose a lot of its value because you have a lot of theta, a lot of time decay. You're getting very close to expiration and you're so far away from that option being in the money, right? But imagine buying a 3-week expiration. You wouldn't have lost as much money, right? Because you still have 3 more weeks to be right on the trade. So that's where trading close to expiration options have a bad name because traders bag hold them. They don't sell them. They let them expire worthless. They don't honor their plans. There's nothing wrong with trading close to expiration options if you can be disciplined enough to cut your loss when you say you're going to cut it, to take the loss that you assessed and walk away, right? So again, same thing with stocks, guys. You could buy 1,000 shares at $2 and be a bag holder. The only difference with an option and the stock is the option will expire worthless. Eventually, if it's not in the money, it's going to go to zero. You're going to lose what you paid, right? A stock that you bought may eventually get back up, may eventually go back up in a year, right? So you may be able to get back to break even, but with an option, eventually it's going to expire. And if you're out of the money, you're going to lose what you paid for it. So again, make sure if you're trading close to expiration contracts as day trades, that you make sure you do your due diligence. You analyze the chart. You assess everything, entries, stop losses, targets. You come into the options chain. You trade, the option contract that has the most amount of volume, the most amount of interest, right? Those spreads are going to be nice and tight. And then you have to just manage your trade right. All right, so okay, I'm risking that 50 cents. I don't want to lose more than $15 on this contract. That means I can't go any higher than a 242.5 call, right? Because if I get stopped out at that 50 cents, if Boeing comes down 50 cents, I'll lose about $15 per contract. But if Boeing goes up and hits target of $1, I'll make about $27 of profit. That meets my plan, right? I'm abiding to my plan, my rules. That meets my plan. This is the one that I can buy. And if it comes down and stops you out, stop out and walk away, guys. Don't get caught holding the bag because you will get destroyed, right? If you stay on the wrong side of the trade, 90% of the time, guys, you will get destroyed and that option will expire worthless and you will lose your entire investment. Can't tell you how many times I did that as a new trader dabbling with options. All right, cut your loss when you say you're going to cut your loss. If it sets back up, you can get back in. But the last thing you want to do is not stop out and watch Boeing fall to $200 today. And now you lost your entire investment when you could have lost $20 freaking dollars. Right? So again, you should trade the strike below since the volume's 10x. Yep, we talked about that. Beth is saying that's how I've traded options, picking the strike below for a call and anticipate of the going higher, as opposed to buying under the strike price and waiting for the price to reach the strike price. Yeah. And again, if you take one thing out of this, just focus on delta, guys. Focus on the delta. It doesn't matter if you buy this one. It doesn't matter if you buy this one. It doesn't matter. Focus on the delta. Your delta is your profit and your loss. Your delta is how much you're going to make or lose on an options contract, right? As long as you can check all the boxes off. $2 a day on average it trades. $100 to $400 because the spreads are low, they're less expensive. The spreads are not more than 5%. As long as you can check all those initial boxes, right? The volume's there, right? There's liquidity. The spreads are tight. It doesn't matter which one you buy. You can buy something that's extremely in the money. You can go buy a 225 and make money, right? If that criteria is met, you're going to pay a lot more money for it, but it doesn't make it wrong to trade it. You can trade a far out of the money option. It doesn't matter as long as you can check those initial boxes, right? So again, delta, 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 delta. That's what you should focus on for day trades. What's the delta? Because you're going to be able to take that delta and assess what your risk is going to be based on the chart. That's how easy you keep options. A lot of people overcomplicate options, guys. You don't have to. Delta. How much am I going to make or lose per dollar move? Then go ahead and look at your levels on the chart, right? Let's say you're risking 25 cents. How do you calculate the delta? At 25 cents, you divide it by 4. That's it. You take the delta, you divide it by 4. That would be approximately the profit loss per 25 cents that the stock moves. What if your stop loss is 10 cents? Divide the delta by 10, right? It's that easy. What if your stop loss is 75 cents, right? Again, you take the delta. Again, it represents every dollar that it goes up or down. And then you just sit there and just do the extra math. Again, if you're risking, 10 cents on the trade, which again, it's really freaking tight. But again, hypothetically, you're risking 10 cents and you're like, but Josh, how do I calculate the delta? I only know that it represents per dollar move. Well, again, you take the delta, you divide it by 10, and that's going to be an approximate representation of per 10 cent move for the delta, right? It's very easy. So if you take anything out of this today, guys, it's just really focus on the delta. right? Focus on delta. That is going to be your profit and loss per dollar that the stock goes up and down. And as long as you can check off all those preliminary boxes of $2 on average, $100 to $400 in price, build yourself an options watch list. Now you know how to trade options, right? You know how to now buy an option based on the criteria that we talked about and how to manage your risk, right? What is the option going to go up? What is the option going to go down based on the delta per dollar move that the stock makes? You know how to properly trade, exit, execute these options. You know how to assess your risk on options. Now we have to find strategies. We have to develop an edge when it comes to trading options, right? Matt has one of the most simple options strategy out there, and it has a great win rate. I mean, maybe it has like a 50% win rate, but the fact that this man can manage his risk appropriately, right? This man is making great money trading options. He's trading close to expiration. He's trading strikes that have around a 30 delta. He trades 20 to 30 contracts at a time because he knows how his risk is going to look on 30 contracts with the 30 delta based on his stop, right? He can do this consistently day in, day out and manage his risk consistently, right? And make consistent profits because he understands the variables of an option, right? He really focuses on delta. And that's what I stress to the newer traders as well is delta, 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 right? That's it. That's what's going to determine your profit and your loss on an option is going to be what that delta is, okay? So again, there was a lot of information spit out there. There was a lot of information, right? We talked about a lot. So if you guys have any questions, please let me know. This is a great time to maybe answer some questions or maybe add to the lesson, but I wanted to keep today's relatively simple. We are going to continue tomorrow and Wednesday with more lessons. Tomorrow, we're going to dive into swing trading options, right? Swing trading options and really talk about the theta. Tomorrow, we're going to talk about implied volatility. When you have an extremely volatile stock, it may not be a good idea to trade the options because they may be artificially inflated as far as the price. When you have a very, very high implied volatility, the options are expensive. When the stock becomes less volatile, right, and the implied volatility drops, it's called an IV crush, an implied volatility crush. When the option is very volatile and all over the place, those options will be artificially inflated as far as the premium. When the stock becomes less volatile or not volatile, just because the stock didn't do anything, the stock could actually be going up in your favor and you could still be losing money because of an IV crush. So tomorrow we're going to talk about implied volatility and how that's important to look for, right? Make sure you're not going to get caught up in an IV crush. How to swing trade some of these. Talking to theta. How far out to expiration, right? Some tips and tricks on if you expect, a swing trade to work out in 30 days, how you shouldn't do a 30-day expiration. You should probably do a 45-day expiration, right? Some other tips and tricks when it comes to options. And then Wednesday, I want to talk about a couple techniques and strategies to trade options in a very simple manner. Very simple techniques, very simple approach, and how you can generate consistent profits just trading one or two strategies with options, and you'll see nice returns and nice rewards. And then to add on to that, how you can actually have a cash account with options and get around the PDT rule, right? So there's a lot of benefits about options. I do not want to throw all this information out today because it's a lot, right? It is a lot. And I don't want to overwhelm you guys. So we're going to break this out into a 3-day series of options. Today, we talked about day trading options, right? Rules. Again, I'm going to rehash these rules for the 5th and final time. I want to make sure if you're just tuning in, you get this. If you've already heard it, mute me, baby, right? So rule number 1, make sure the stock trades on average $2. Rule number 2, try to find stocks that fall within that $100 to $400 price range. Why is that? They're going to be less expensive and the spreads aren't going to be as aggressive, right? Rule number 3, before buying an option, make sure the spread is less than 5%, okay? Make sure the spread's less than 5%. Rule number 4, before buying an option, look at the volume, right? Does it have a lot of volume or does it have no volume, right? You want to find the ones that have volume. Again, you have to think of penny stocks, for example, liquidity. There's a lot of hype and there's a lot of interest and there's a lot of volume. Spreads are tight. because there's a lot of people trying to get involved, in and out, in and out, in and out, in and out. Spreads are going to be closer together. You find a penny stock that has little to no volume, right? It's stagnant, low liquidity. What do you notice on the level 2? You notice large spreads. So volume plays a huge factor when it comes to spreads. All right, so again, make sure there's a lot of interest. Make sure there's a good amount of volume, because that's going to assist with keeping those spreads nice and tight. So if the trade goes against you, the spread doesn't open and you take a much aggressive loss. So again, volume, rule number 4. What's the volume? Trade the one that has a lot of volume to where you know that spread's going to be tight. It's going to be easy for you to get in and get out and not take a lot of slippage. Okay, guys? So again, those are your 4 rules. And then number 5, delta. What's the delta? All right, let's say it's 30 cents. That's the delta. I know that for every dollar the stock goes up, I'll make $30 per contract. For every dollar the stock goes down, I'll lose $30 per contract. What's the delta? Take that information from the option. Take that delta and overlay it on your chart. Do your analysis. I want to buy here. My stop loss is here. I want to sell here, right? Now, based on that 30-cent delta, how much am I going to lose per contract if I'm stopped out? How much am I going to make per contract if I hit target, right? Okay, I'm exceeding my stop a little too much. So that means I can't do a 30 delta. Maybe I need to go to a 22 delta. Take that delta, overlay it on your chart. All right, so if I'm stopped out, based on this delta, I'll lose this much. Okay, that's within my risk tolerance. So now you've determined, based on delta, this is the options chain that I can actually get to not veer away from my plan and my stop loss. The spreads are nice and tight, has good volume compared to some of these, right? It's not the best, but it's still good volume. There's a lot of interest, right? The liquidity's there, the spreads are tight, and that's it. So today is day number 2 of our options lesson, all right? Yesterday, we talked about the basics, right? We talked about the delta, right? What the delta represents. We talked about the theta, what the theta represents. We talked about volume, right? How the volume impacts the spread. We also talked about how you need to have rules of no more than, say, 5% spread between bid and ask if you're going to get involved. That is my rule, 5%. We talked about the price range of stocks to where the options are affordable for newer traders and where the spreads are typically tight as well. But again, how volume plays a big factor with the spreads, how the price of the stock plays a factor with the spreads, and how cost effective they are. And then also introducing the SPY, right? How the SPY has 3 expiration dates per week. You have a Monday, a Wednesday, and a Friday expiration. And again, we can trade close to expiration options. So what makes the SPY beneficial for newer traders to start with options? What is it? It's the fact that you're getting very close to expiration calls and puts to where they're going to be very, very cheap to buy, right? Even today, with the SPY expiring tomorrow on these Wednesday contracts, you can come in, again, find something that has like that 27 or 30 delta, something that's trading good volume. There's interest. The spreads are tight. You can buy an option for approximately $100, right? That has a $26 delta. If you got a full dollar move out of the SPY, you would make approximately 26% on that trade. So number 1, they're affordable. Number 2, the spreads are tight. There's always a lot of activity, a lot of attention, right? The deltas are pretty rewarding as well. So overall, as a new trader, it's best to start trading with the SPY. Start with 1 contract, then go to 2, then 5, then 10, and slowly scale like Matt had done over 10 years to where now he's taking 30 contract positions and locking in $1,000 trades, which is just absolutely amazing. But you have to start somewhere, and I recommend starting with the SPY for those reasons we just talked about. You don't need a lot of capital, right? They're less expensive. The spreads are nice and tight. The deltas are nice. There's always volume. Meets all the criteria for something that we need to look for before trading options. So again, that was our lesson yesterday, really just breaking down an options chain, how we can day trade them, what to look for. Again, really breaking down the delta and how we can take this options data, right? All of this data that we have in our options chain and overlay it on the chart, right? To get an idea of what our risk and reward is going to be. All right, that was awesome. Now looking at those puts that, again, we were hypothetically taking. I tried taking them. Again, I wasn't able to get my position. We were buying the 408s around 130 a contract, right? Had a 30 delta at the time. They were about 130 a contract. I was looking to take profits back down towards around 411. We said, like, per contract, we should see about a $30 to $40 increase in those if we get that dollar drop. We got our dollar drop. We were buying them at 130. They were currently worth 170. I was looking to buy 2 contracts, and that would have been about $80 in return, and I was looking to risk $30 to $40. How did I know what my risk and reward was when I'm not physically buying shares, right? For every share you buy, for every dollar it moves, it's $1, gain or loss, right? It's easy with shares. So how was I able to break down this options chain and get an idea of what my risk reward was going to be? Again, it was all tailored around the delta. The delta was 0.30, which means $30 for every dollar the S&P goes up or the S&P goes down. I was risking 50 cents on the chart. So half of the delta would be $15. I was looking to buy 2 contracts. So again, if I would have been stopped out at that 50 cents on the chart, my option would have probably lost about $30 of value based on the delta and doing the math. How did I know I could have made about $70 to $80? Well, again, the delta was 30. The stock coming down $1 to my profit target, right? $30 of delta per dollar move times 2 contracts, $60. And I was looking to buy those at 130, right? And I could have made, at that point in time, as we just looked at it a few moments ago, roughly $60 to $80 in profit. Again, I was able to plan my trade, manage my trade, understand my risk in the trade, all because of the delta. All right. So again, we talked about delta yesterday. I hope you guys really understand. If not, I will be posting this lesson up later this week. We have yesterday's lesson on options, today's and tomorrow's. It's a 3-part series that I will have uploaded by the end of the week, so you can dive back into these lessons and get educated if you want to trade options. So today, let's go ahead and get started, guys. We are going to be doing options. Day number 2, we're talking about implied volatility, what an IV crush is, give you some examples of an IV crush, and then how to swing trade some of these, right? We talked about day trading options. But what if you actually want to swing trade a stock? Let's say you see Apple, right? Let's say you're analyzing Apple and you're like, you know what? I like Apple, but I can't buy enough to make any money, right? I could buy like 10 shares, 100 shares, right? 10 grand, but like for every $1 or $2 it moves, I'm making like $100 here, $200 here. Again, I don't have that much capital, or I don't want to tie that much capital up into, the actual equities because it's a $100 stock. So again, if you're restricted to capital, but you want to swing trade some of these big name stocks, Apple, Tesla, Boeing, Snapchat, and you cannot afford a good amount of size to actually see any kind of return or reward from it, how do you actually participate? Options. So we're going to be talking about swing trading options as well. So let's go ahead and dive into it. I put together a little bit of a note, again, just so you can take a screenshot of this, you can type it. Again, you can write it down, but again, this is just some terms and terminology when it comes to implied volatility and a few notes to keep me on track today with our options lesson. So, excuse me, let me take a drink and we'll go ahead and get started real quick. All right, so we're going to talk about IV, the implied volatility. Okay, very, very important to understand what the IV is, the implied volatility is. Implied volatility represents the expected volatility of a stock over the life of an option. As expectations change, option premiums react appropriately. Implied volatility is directly influenced by the supply and demand of the underlying option and by the market's expectation of the share price direction. As expectations rise, or as the demand for an option increases, implied volatility will rise as well. Okay? Options that have high levels of implied volatility will result in high-priced option premiums. We talked about this yesterday, right? A high implied volatility, basically the supply and the demand being high, being a lot, will increase the IV, the implied volatility, which will increase the value or the premium for that option, right? I say it artificially increases the premium of the option. So let's use SPY as example, right? Let's use the SPY as an example. And we're going to use a 411 strike for tomorrow's expiration as example. This right now has a 21% implied volatility. That's normal for the SPY, right? So on average, the SPY has about a 20 to 30% IV. And that's what prices these options, okay? But let's say Jay Powell comes out, right? Fed Powell, bad news, whatever the case is, and you see the SPY get volatile. Let's say we see something like yesterday where the SPY is just falling. There's a lot of volatility. This stock is moving aggressively. That would make the supply and demand go up, which would increase the implied volatility from, say, again, hypothetically, from 20%, and let's say the implied volatility is now 50%. That alone, the implied volatility increasing due to the stock being wild, supply and demand increasing, will increase the value of the premium. So it would no longer cost you $200, $270 to buy. It may cost you $400, right? So, okay, still not bad. But here's the thing. Let's talk about IV crush, implied volatility crush. So again, we know how when there's a lot of supply and a lot of demand, that increases the implied volatility, okay? Here's the thing. Let's say you buy into that with a high implied volatility, right? Let's say the S&P is volatile. The implied volatility increases to, say, 50%. And then let's say the SPY sits sideways. Let's say volatility stops, volume dies down, and it just sits sideways. And it's not really doing anything as crazy as it was. That implied volatility is going to go from 50% to 40% to 30% to 20%. So imagine buying a put here with a, 50% implied volatility. It's dumping. The IV's going high, right? The implied volatility is now from 20 to 50%. You're buying puts, right? You're in the money. You're making money, and then it stops. And it just sits sideways. And it loses that, that volatility, right? But you're in up here, right? You're in right up here at that first gray box, right? You were making money along this big move down, right? This whole move here, you were making money. But then the volatility stops, right? It sits sideways. You could actually lose money. You're like, what do you mean, Josh? I was buying puts when the price was at $421. It's at $419 now, right? So you would think you'd be up $2, right? You would say that $2, multiply the delta, and you would be up. But as the stock sits sideways and consolidates and loses volatility, if, again, this is hypothetical, but again, we do see this a lot, that implied volatility then go back down to 30, to 25, to 20. So you're technically still up. Looking at the chart, you're still profitable. If you would have bought shares, you would be profitable in that trade. You would still be up $2 a share. But the fact that the stock is settling down, right? The implied volatility is slowly working its way back down to its norm, 20, 25%, right? During that extreme volatile period, it got all the way up to 50%, hypothetically. You're still in the green, technically, looking at the chart, but as the implied volatility starts to go back down to its norm, so will the value of the option, right? That is called an IV crush, an implied volatility crush. The IV going higher increases the value and the premium of the option. Whenever the implied volatility settles back down and returns to its norm, so will the prices of those options. So just because you're up in green in a trade, and just because the stock is sitting sideways, but technically you think you're in a good trade, right? You're up $2 a share, technically. The fact that the IV starts coming back down, you could actually get back to break even or even lose money because of an IV crush. I cannot tell you how many traders were reaching out to me during the AMC and the GameStop hype saying, Josh, they said, Josh, dude, help me. I don't know what's going on, right? I'm in puts, or what were they in? Calls, whatever the case is, right? I'm in on GameStop. I'm in, right? GameStop's up $50 a share, but I'm down on my option. Why? Well, they bought in when the stock was really volatile one day. The stock was wild. The IV was like 200%, right? It was crazy. The stock still moved up 50, 60 bucks. They were up $60 a share, but the stock lost the volatility, right? It died down. It wasn't as crazy as volatile. So their IV of say 200% goes down to 100%. They got crushed because of the IV. So even though they were up on the trade, looking at the chart, the technicals, they were up $50 to $60. They were actually losing money on the option because they were buying an inflated and artificial price, right? The volatility artificially, inflated the cost of that option. And when volatility died down, those options returned to normal, right? They returned to normal. So they were losing money even though they were up $60 a share from their entry, right? So that's why it's important to understand implied volatility, right? You do not want to be trading something that has a 200% IV. That's crazy, right? Let's say the stock's volatile and you're jumping in and then the stock dies on off. Not only could the trade go against you, but then you're losing that implied volatility and you're getting crushed with an IV. Now you're getting crushed because the stock's coming down. So now you're just getting hit from both sides. You're bow, 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 just getting smacked, right? So again, implied volatility is very, very important. Again, a lot of people reach out in regards to GameStop and AMC. Josh, why am I down? But I'm up, but I'm down. It doesn't make sense. IV crush. Look at that implied volatility. It was ridiculous, right? And then they just got crushed with the IV. And then some people were on the wrong side of the trade and they were getting an IV crush. So they were just getting destroyed on these options. So again, before choosing an option, understand the implied volatility. Understand what it is. Be mindful of it, right? The higher the IV, the more risk you could potentially take if the stock settles down. Now, here's the nice thing if you're on the right side of the trade. Let's say you get in when the IV is low, right? Say like 50%, and then there's a lot of volatility. Then the IV goes up to 200. Not only are you on the right side of the trade and you're collecting delta premium for every dollar, now the IV is going up, which is inflating the value. So that's where you can actually be on the right side of the trade and make a shit ton of money, right? If you're on the wrong side of the trade with an IV crush, you're screwed. But let's say you get in before the IV gets high and you get out before the crush. Not only are you going to make that delta per every dollar move, but now you're going to see those, option premiums inflate, artificially go up, which could, be very rewarding. So not only is it bad, it could be good, but you just have to be mindful of the IV, right? You have to just be mindful. You do not want to be buying something that has an IV of like 200%. And here's a tip. Options before earnings, the IV is typically higher, right? So one thing is why we don't swing options through earnings is because the IV is typically higher leading up into that time. And then after earnings, the IV goes back to normal. Just a simple IV crush. That's why we don't swing options through earnings. I've done it a few times. I was up in the trade, but the fact that it wasn't volatile, I lost money. And I was like, dude, I'm up $10 a share. How am I losing money on this option? The IV crush, guys. So again, the IV, implied volatility, represents the expected volatility of a stock over the life of the option. All right? Options that have high levels of implied volatility will result in high-priced option premiums. Conversely, as the market's expectations decrease or demand for an option diminishes, implied volatility will decrease as well. Options containing lower levels of implied volatility will result in cheaper option prices. All right? Again, we talked about IV crush. Now, moving on, swing trading options. All right? Now we know what the delta is. We talked about theta yesterday. And when you're swing trading an option, not only do you need to be mindful of the implied volatility, not only do you need to be mindful of the delta, you need to be mindful of the theta. This is time decay, right? Your theta is the decay of your option contract for every day that you hold it. So we're still going to use GameStop as an example, okay? So GameStop, let's say you think GameStop, all right, is going to go to 150 by Friday, right? So you want to come in here and buy a 150 strike. So you're going to come in and say, all right, it's going to cost me 440. I'm not saying this is a good one, right? Again, the spread is large. The IV is slightly high. We wouldn't want to be buying these, right? But this is just for an example. So let's say, hypothetically, you think by Friday, GameStop is going to be at 160. So you're going to go ahead and jump in and buy a 150 call because you want to be in the money on Friday so you can sell for a nice premium. Okay, so you would come in here, Friday's expiration, 150 strike. You could buy one of these call options for $440. All right, let's say GameStop does nothing, right? Let's blow the chart up. Let's give you a good representation. Let's say GameStop does nothing and it sits where it's at right now all the way into tomorrow. So let's say this is its range. That gray box is its trading range for the rest of the day, early tomorrow, right? The stock is not changing in price, right? From a delta perspective, you're not up, you're not down, right? The stock hasn't gone up in price or down in price. So from the delta perspective, you're break even, right? But what you have to be mindful of is the theta. For every day that you hold an option, you will lose money based on the theta. That is the time decay. For every day you hold an option, you will lose money. The closer to expiration you are, typically the higher that the theta is. So again, if we come here and look at 3 day until expiration, again, GameStop, looking at a 150 strike, you could buy it for $440. But again, if GameStop does nothing and does not trade up or down and it's just flat, you will lose $91 just to hold it. Just to hold it till tomorrow. You're going to lose $90 on that contract, right? Why is it $90? Why is the theta 90? Because you got 3 days until expiration, right? You have 3 days until this option expires. And the odds of GameStop being in the money by Friday is slim to none. That's why the theta is high, because it's just being devalued the closer we get to expiration. And the day of expiration, close to the end of the day, if we are not anywhere close, you're going to have a zero. No one's going to be buying and selling it, right? Now, let's say that you're smart and you're like, you know what? I think GameStop will be there by Friday, but why would I want to buy a Friday expiration, right? Why? I want to still have a little bit of time. So what's the benefit about going, say, the next week out? Your theta is going to be significantly lower. So right here on a 150, 89 theta. You're going to lose $89 every day you hold this. We come down here to a 150. Your theta is only 50. So now you're actually almost cutting your loss in half just to hold this, right? If you think GameStop is going to hit 160 by Friday and you come in here and you buy a 3 day expiration 150 call just to hold it until tomorrow, you're losing $90 if it does nothing. Or you can come down here and say, you know what, let me give myself a little bit more time to be right. Not only that, if GameStop doesn't do anything today, tomorrow, and Thursday, but then it moves Friday like I expect, right, hypothetically, I'm only losing $50 a day. So I'm actually saving $40 a day, right? I'm going to pay a little bit more for the contract, but I'm not going to lose as much money because of the theta. So when swing trading options, guys, you just have to be mindful of what the theta is, right? Where did my sticky note go? Where'd my little sticky note go? There it is. All right. So again, swing trading options, the big thing that you need to be looking at is theta. The last thing that you guys want to do is get in something that has a high theta, the stock do nothing, and you're actually down just for holding it. So again, you have to be mindful of theta. The lower, the better. But you always have to build your plan around delta and theta, those variables, right? Again, you just have to be mindful of it, and you have to calculate what that loss could be, right? Based on the delta, based on the theta. Take all of that into account. It's a little bit of simple math just to calculate that based on per dollar move, per day that you hold it. Again, we know what these terms are. Delta is for every dollar the stock goes up or down, what you're going to make or lose. The theta simply is for every day that you hold the contract. That's how much the contract's going to lose in value. Okay, so again, the lower the better. So next, talking about swing trading, right? A good tip is, let's say you think Apple now. We're looking at Apple as an example. Let's say you're like, you know what, Josh, I really like that we bounced off that 200-day moving average, all right, on Apple. And we gapped down from around 126.85. You know, I know Apple only moves 25, 50 cents a day on average, maybe $1 when it's volatile, but I think Apple by Friday is going to close that gap. All right. So you think by Friday, Apple's going to be around 127. So you want to come in here and look at a say a 126 call. So right here, you can buy a 126 call for about $100. Just to hold it until tomorrow, you're going to lose about $20. All right. But let's say you're like, you know what? It's risky, right? You're only giving yourself Wednesday, Thursday, and Friday to be right. What if it kind of sits sideways for the next few days and then starts filling the gap next week, right? You have the analysis. You can see that it has potential to fill the gap, right? But you want to give yourself a little bit of time to be right, especially on swing trades. The last thing you want to do is say, I think this is going to happen on Friday, and buy a Friday expiration contract, it not hit target on Friday. The theta is eating away the value of your contract because you're still out of the money. And now your contract expires worthless just to watch it gap up Monday, and you could have been in the money. So when swing trading options, identify when you think your price is going to be hit, and then add a week or two to the strike that you're buying. So if you think Apple by Friday is going to close this gap at 127, don't buy this Friday's expiration. Buy next Friday's expiration, just in case it takes an extra couple of days for you to be right. And if you're wrong, the theta is going to be lower, so you're not going to lose as much money if you're wrong. You're going to pay a little bit more money up front to buy the option, but you have the benefit of, again, having a little bit more time to be right, and then also having a reduced theta. So just by holding it for a few days, you're not going to lose as much money. Again, the theta here on the 126 is $20 per day. We go to next Friday, the 126 is $12. It's been cut in half. Right? So if you hold this contract 3 days out, you're going to lose $60 if Apple sits sideways. You're just going to lose $60. That's half of the value just to hold this for 3 days. But if you come down here to hold this one for 3 days, you're only going to lose $30. But again, it's about double the price, right? It's about double the price. You're going to pay $212 here. You're going to pay $117 here. So you're paying an extra $100 for the contract, but you're only losing $30 for that 3 days, assuming Apple does nothing, versus losing $60. That there would be 50% loss right here on that 126 call. That would be about a 50% loss just from the theta over 3 days. You come here, that would be about a 10% loss, 15% loss of the theta over the course of 3 days. So again, 50% loss on a close to expiration contract, right, over that 3 day hypothetical time span, or 15% loss if, again, Apple sits sideways. I would rather pay a little bit more money and take a lighter loss, 10 to 15%, versus buying something that's less expensive and getting crushed from the theta. Does that make sense, guys? Does that make sense? I hope it does. So again, you got to first off identify your setup, your technicals, entries, exits, profit targets, stop losses, right? And then you have to identify, when do I think I'm going to be right, all right? Let's say you think you're going to be right in a week. Let's say you're looking at the chart, you're getting a feel for everything, and you think that we'll end up coming back up. Actually, let's do this. Let's say I like the bounce. I think that we'll come back up and retest 130. And you're looking at it like, okay, here's the bounce. It may close. It may pull back. May get another little pop. And maybe by the 28th, you're thinking maybe by the 28th, Apple will be back up towards around 130. All right. Maybe it'll be back up towards around 130 here on Apple, right around here. So that's your prediction. You think Apple will go from here back up to here by the 28th. Don't go buy the 28 calls. Don't go buy these, right? If you expect to be right at your strike or right at your target on that day, you're right at the day of expiration. Those options are going to be, right? Just because you're like, hey, it hit 130 and I have a 130 call, baby, woo! You're not going to make as much as you think because you're holding it into the week of expiration, into the day of expiration, and your theta is crushing you. Your theta is crushing you, right? You're getting hit. So again, give yourself time to be right. And the thing is, too, if you're swing trading these, ideally you want to sell them a week or two before expiration. So again, give yourself a week or two to be right. So if you come into it and you're like, all right, I've done my due diligence, I've done my analysis, I think by the 28th, we'll be at 130. I want to give myself 2 weeks to be right. So you'll come in here to the 28th, and you'll just go out 2 weeks. So now we're going June 11th. So you're giving yourself an extra 2 weeks to be right around June 11th, right? So you're giving yourself until this purple line to be right, but you expect to be right on the red line. So you're giving yourself an extra little bit of window. So now, again, not only are you giving yourselves 10 more trading days to be right, you're also getting a much less theta. And the fact is, if you hit target, if you're in the money, 2 weeks before expiration, right? Your options are going to be very valuable. Your options are going to be up in the money, right? You're going to pay more for it. See, if you're going for a 130 call on Apple, 31 days out, paying $200 for it, which is not bad. But if you go 17 days out, you're paying $119. Okay? So again, they're a little bit more expensive, but you're not going to take as much heat. You got a 5-cent theta versus a 7-cent theta. So the theta is not too much, right? You got a 27-cent delta, and here you have a 33-cent delta. So again, about a 6-cent difference between the two. But again, if you bought that May 28th contract, right? Because you think by May 28th, you're going to be right. The day of expiration, let's say it's at 129. Let's say it's at 129, the day of expiration, right? And you're about $1 away, and you got 3 hours of the market to go. That option, guys, is going to be like a $20 option, right? It's going to be a $30 option. It's going to be worthless. But if you would have just went out 2 extra weeks and you're $1 away, you're going to be up in the profits. You're going to be making money because you're so close to being in the money, and you still got 2 weeks until expiration. So that option is going to provide you more return from a percentage standpoint than the other one would. So if you want to swing trade, right, you want to buy options and hold them for a few days, a few weeks, a few months. Identify when you think you're going to be right. Look at the chart, do your analysis, do your due diligence. When do I think that this stock will be at a certain price? Identify the time. Add a week or two to it and buy that expiration date, just to give yourself a little bit more time to be right, so you don't have an option that is expiring the week of expiration, right? You're not holding a contract that expires that week on Friday, right? Because just because it's a Friday expiration, you're going to see it devalue a lot. That theta is going to be increased substantially that week. And again, you got to think these thetas move. So it's not going to sit, right, at 8 cents every week until the end. It's going to slowly go up, right? Your theta is going to go from 8 cents a day to say 10, and then 12, and then 14. And then you can see some of these are 18, right? So again, this is not permanent. Your theta will become higher, will increase the closer to expiration you get. The delta, the closer you are to being at the money or in the money, the delta will increase as well, right? So look, for every dollar Apple goes up, your delta will increase about 5 cents, all right? If Apple goes up another $1, your delta is now 42. So every dollar that the stock goes up, you make that delta, but then your new delta for the next dollar move will be slightly higher. You can see from the bottom to the top that every dollar increase, the closer to in the money you are, the higher the payout is from delta. So again, the delta doesn't just stay the same, right? It will increase or decrease the further or closer away to being at the money you are. And when we talk about out the money, we're talking about this, the price at the money, right? Everything in this purple shade here, everything in this bluish purple shade is in the money. Everything down here is out of the money. Right here below that purple shade, so that would be a 126 strike. That blue line would be an at the money. So again, the closer or further away you are from being at the money will determine your delta, whether it's higher because you're close to being at or in the money, or it'll be reduced because you're further away. Okay, guys? And the same thing with the theta, right? You can see the theta is really, really low. The further out you go, it gets pretty high the closer in you are, and then the further in the money you go, the theta starts going down, right? So you can kind of see how that works on out as well with the theta. So again, those things will change each and every day. So you always have to come back in and reassess. Is the theta still okay? Is the implied volatility still okay, right? How's the delta, right? Reassess periodically, day over day over day. And again, always give yourself at least an extra week to 2 weeks to be right if you're going to swing trade any kind of options. Because again, the last thing you want to do is have a contract that expires this coming Friday and you're still $1 or so away from, hitting your target. And even if you hit your target, you break even or you lose money. That would probably piss you off. You're like, man, I nailed it. I was right. It went to 130 by that date. But the fact that my option expires today and we're about 50 cents away, it's just not as valuable as I thought. Man, this stinks. If I would have only paid an extra $100 for that option going 2 weeks out, I would actually be profitable right now, right? If I would have just invested a little bit more, went a little bit further out, I would actually be making money because my analysis was correct. The last thing that you want to do is get an option too close to expiration, be right, and not make money. Because that's the most annoying thing. When you're right on a trade and you don't make money because of an option, that's going to stink. So again, always give yourself at least an extra week or two. So again, if you think that it's going to take you 30 days to be right, go 45 days out, guys. Go 45 days until expiration. Understand what your theta is. Your theta is going to be for every day that you hold that contract, how much you're going to lose, assuming the stock sits sideways. Your delta is how much you're going to make for every dollar the stock goes up and how much you're going to lose for every dollar that the stock goes down. Always be mindful of the IV. IV is implied volatility, right? The higher the implied volatility is, the more expensive the contracts are. The lower the implied volatility is, the cheaper the contracts are. So if you get into a stock or an option that has a high implied volatility and then it levels off and the implied volatility goes back down, you will lose money on that option because the implied volatility is decreasing, which is making these contracts cheaper, right? And that is what we call an IV crush, an implied volatility crush. I've seen it time and time again. I've personally dealt with those before. They're not fun because you're on the right side of the trade. The stock goes stagnant, but you're still up $10, $20, $30 a share basically, but you're losing money on your option because the IV was at 250 and now it's back down to 100. Just because you didn't look at the implied volatility. And if you would have looked, you'd have been like, shit, I shouldn't be buying these options right now. That's crazy. Let me not buy them. Let me buy shares. Let me just stay away, right? So implied volatility is very, very important. And you need to look at the IV per option. So here on TD Ameritrade, to add these settings, to add these Greeks, to add these indicators and, basically settings, you're going to go right up in here to layout. So you're going to click your layout. You're going to come down to customize. And all you have to do is just type in implied volatility, add it. Type in volume, add it. Type in open interest, add it. Add your Greeks, delta, gamma, theta, vega. All right, hit OK. And now you can actually see what that is, what the open interest is, what the volume is, making sure you're not getting in on something that has light volume, something that has good volume, right? Again, looking at your spreads, looking at what the implied volatility is on that particular option, because it's going to change the further out you go, right? It's going to be slightly different, right? A 131 for this Friday and a 131 for next Friday has about a 2% difference in implied volatility. All right, so again, understand what the IV is. And then again, make sure you have your Greeks. The top two that I want you guys focusing on is delta and theta. All right, guys? So if you have any questions, comments, concerns, please let me know. Again, I really wanted to break down IV today, IV crush. Again, swing trading these, a couple tips and techniques to make sure that if you predict to be right at a certain time, that you're giving yourself enough time to still make money on these options and that you're not sitting back like, man, I was right, but I'm actually losing money. This stinks. This sucks. I wish I would have went an extra week or two out because then I would have been profitable, guys. So that's what I recommend if you want to swing trade. Again, just being mindful of what the theta, the delta is, and most importantly, that implied volatility.
I got in somewhere around this general area and everything. At that point, it got flushed down. I took half my profit here. Came back up, came down, and on this part, when it couldn't get through this part, that's where I closed out, somewhere around here, and everything. But once again, I mean, you could easily make a case for different ones and everything, and you have to just be mindful of what lines are drawing, because lines are very subjective. They don't always work. They're all could be written and drawn any which way, and so it's a very subjective thing. I don't, as you can see, I don't use indicators. I use literally lines that I draw manually, and I just go and enter the trades. At that point, once I see the stuff forming and everything like that, I use a ladder, and I can just switch it this way.
And while you go ahead and pull that up, I just do want to add to that because again, I know my whole there we go. I know I'm a big visual learner, so just to kind of hit on what Matt's talking about. Again, he doesn't use indicators. He doesn't use a lot of studies, really. He's just looking at, again, price action, the candle closures, and really just the overall trend. So when he's actually establishing his trend lines, the first point in which you connect it. So when you start to draw your trend line, that does count as point 1, right? So let's say it pulls back and puts in this low here, and it comes back up to the trend line. That's going to be his point 2. And for what I'm gathering, he wants to take the trade on point 3 only if, again, hypothetically, if we're looking to take a short, he wants to see the stock make a lower low. Basically, waiting for that lower low confirms that we are in a downtrend, right? We have the lower low, we have the lower high, followed by a lower low. He's waiting for that confirmation, basically waiting for the confirmation of that lower low. And then if it were to come back up into that third point, that would be a good signal for Matt to get in, right? Those are going to be his 80-20 setups. When he sees the third point coming off of a lower low, and then the same thing with going long, you establish the same exact trend, right? You're going to wait for that point 2 with a higher high back into that third point here. And those are going to be Matt's 80-20 setups to actually take something like that long. So what he's really talking about here is, why would he not take the trade if, hypothetically speaking, I'll let Matt get back to it so I don't ruin his thing. If
all good, looks good.
If the stock, right, like this, right, guys? So let's go ahead and get my little tool out. Boop, boop, boop. If the stock, you notice it at point 2, right, and it's coming down, and you see it form a higher high into point 3, right? It just gets risky, right? That's where it really goes from 80-20 odds to like 50-50. Could it bounce and come down, right? We saw that on Tesla. Could it tag it and come on down? It could. But could it break off that point? Yes. And why is that? Because we have not established that lower low, right? We aren't really technically in a downtrend because we technically just put in, almost a higher low here. And if we get that break, right, we have established a possible reversal with that higher high confirmation here off a higher low. And we could then see this reverse to the upside. So again, the reason why Matt's not taking those third point trades off of say a lower high or a higher low is because it just becomes really 50-50, right? Could it bounce here and move up? It could. But again, could it crack and continue its way down? It very well could. So again, the main thing that we're going to take away from this, guys, is when we're looking at connecting our trend lines and we're looking at taking these longs or these shorts, these trades into the third point have to come off of a lower low or a higher high, and that's going to give you a little bit more validation. It's going to increase those odds 70-30, 80-20 to get that proper bounce to bring that trade in your favor. Okay, so the one thing I want you to take away before we move on is, again, you got to wait for that third point, and it needs to be coming off of a lower low or a higher high before you get involved. If it doesn't, it really reduces your odds to about 50-50, and that's gambling, guys. We're not here to gamble, are we? No, we want to find high probability setups with high odds to increase our edge in the market to stay consistent. All right, so Matt, I'll go ahead and let you carry on.
Awesome. So, I know you talked about day trading options Monday, I think, or Tuesday?
A little bit Monday and a little bit Tuesday, yep.
So this is basically how I do it. So I don't really trade shares like Josh does. I show it in the chat because it's a lot more complicated than telling you guys what strike price and what option that I'm trading. So this is basically what I'm doing. So if I see a setup that I like, and I'll just use Tesla. Let me find Tesla. So I'm just going to slide this over so you guys can see it. So Tesla, right here, where I got a lot of squares on here, so hang on, let me clean this up. Otherwise, I'm going to be visually confused myself. Okay. These were my 2 point of entries during Tesla. And if you look at, let's see, 12. All right. So if I see a setup starting to form, I will immediately have, I have multiple screens, so that does help. If you're trading off of a laptop, it's very, I mean, how I trade, it'd be nearly impossible. But I know everyone trades differently and everything. I have multiple screens and everything set up. I can kind of show you real quick before we go into the option portion. Let's see, new share, and so this is my main screen right here, and that's on a 55-inch TV that's mounted on a wall. That literally all I do is observe. I don't draw on it. I don't do anything with it. I don't touch them. I literally am just observing. Those are the main stocks that I am always looking at, focusing on, and stuff like that. Um, After that, then I go and I have that always in front of me, and then I change it to this one, and I wait for it to switch. There we go. And so these are the main stocks that I look at outside of the ones that are on my TV is Apple, Facebook, Q's, Spy, Microsoft, Walmart, Disney, PayPal, JP Morgan, Tesla, Netflix, Nvidia, AMD, Alibaba, Boeing, GME, and Roku. And I only trade those. I don't trade anything else. I don't trade anything I don't know. It needs to have uh, the option chain needs to be close knit on the spread. You can't have a giant spread like Josh was showing you the other day, where if you have most stocks have an option chain, but they need to have a close enough spread on them to make them tradable. There needs to be a lot of open interest. There needs to be a lot of volume. It needs to be tradable, and there are only probably 15 or 20 that are truly tradable day trading wise, because the spread needs to be very close. It also needs to be to move. Like AMD, for instance, AMD is a great stock, but it doesn't move. I mean, you're at $75 right here, almost 70, 76. The whole day it's moved $1.50. I mean, which is, yeah. I mean, look at the move here. This is a massive move here from 78 to 70, about 76. So it's a little over $2.50. That's the big move that it made. So you need something. I mean, and that's a big move because it was a big pre-market drop and then dropped even more. Same with this, another pre-market drop and it shot straight up. So it needs to move. Even on the biggest move probably in the last 3 months, you're still looking at 73-ish all the way up to 77. You get the $4 move. I mean, just look at again, look at Tesla. I mean, Tesla moved $4 inside of one bar. So, so it's an absolute no-brainer. Same with Netflix. Netflix is the same thing. And oh, I didn't talk about Netflix. So, and I can quickly shoot this over real quick. I took a Netflix one as well. This was a three-bar prong where it went up, went down, hit again, went up, went down, higher high, came back, hit the bar, perfect. So I took the trade for a long. Obviously, as a loser. It went straight down. That's going to happen. It's going to be a loser. You just have to set your stop, and if you can get ahead of the curve, great. I noticed that it broke trend really early, so luckily I was able to get out early and just market ordered out really quick and everything. But normally you might not be able to get that quick. You just, if it hits your stop, if the stop is here, so be it. If the stop is here, so be it. But you don't move your stop unless you're exiting the trade for a reason. I was exiting that trade because it broke trend. I didn't want anything to do with the trade, and I was trying to limit my exposure. So that's why I exited. In regard to day trading options, when I go to an option chain, I pull up Tesla. I like Tesla, liked what Tesla was showing me. I'm like, all right, great. So I type in Tesla. I go into the most recent expiring contract, which is the May 14 of this year. It's got 2 days left to expiration. I go down. Here's my delta right here on this column. I guess first look at open interest. Open interest are resting contracts that people will take. So like if I wanted 1,100 contracts filled, I can get it filled right now, this second, without waiting on that particular strike price. But over here, I couldn't get 1,000 orders filled. I'm not trading 1,000, nowhere even close. But I'm just using that as an example. Over here, there's absolutely no open interest on this one. See, it's 0. So you got to trade a strike price that has open interest, and a lot of it. And you need to look at the volume. See over here, not much volume in the money options from the call side. But over here, out of the money options, 16,000, 17,000, 10,000, even the little ones at 5,000 and 7,000. So it has been trading a lot all day. Same thing on the put side. Oh, this is calls. If you didn't know, left column is calls, right column is puts. I'm just so used to options now that it's just second nature. Options and stock equity, it's totally different language, totally different world. I will tell you that I was very fluent in futures, very fluent in equities, and it still took me over a year to actually speak and understand options. Not even that well, but pretty decent where I could trade it without making too many mistakes. So trading options is a different language altogether. It is going to take a lot of work, a lot of reading, a lot of just habit and practice, paper trading practice. And if you have Thinkorswim, the on-demand option when you go to paper trading is phenomenal. Pick a day, whatever. You can go back 10 years. Pick any day you want, trade it. Options are a little goofy. Sometimes they work, sometimes they don't. More recent data in the last, say, year, the options work a lot better for practice trading on demand features. Whereas 7 years ago, 5 years ago, the data's there, but sometimes if you're trying to get filled, the computer won't fill you. So, I mean, I still go back and paper trade just to see, all right, if I did this, what would have happened? So it's very, very helpful to do. Very helpful. And I will say, I paper traded for a year. And it sucks because you think you're making profit, you're doing great, and you want to go into cash. And then you go into cash because you were making profit for a few weeks in a row, and then bam, you get wiped out. And then you start all over again. It sucks. It really, really sucks. And that's why most people quit. They think they're making money. They're hand over fist for 2-3 weeks. They have their strategy figured out. Then they go into the live conditions and just get slammed. It sucks. It's a totally different world. Your heart starts beating different than playing with paper money. It's just different. So you use smaller size. Stay in the game for a long time. That'll keep you around for years. Even if you have millions of dollars in your account, smaller size. I've heard people say even if you have $1 million, you should be only trading with 1%, 2% per trade if you're day trading. So just keep it within terms. Once you find a trade though that you like, and let's just use the Tesla trade that I was looking at for short. So I go over, if I want to short something, I'm buying a put. If I want to long something, I am buying a call. This particular one was a short. So I like to trade off of a DOM, but I also like to see the chart. Excuse me. So when I go and look, I see open interest, 4,000, 4,000, 4,000, 0, 0. I don't want to touch any of these. So I want to go into something that is relevant and has easy open interest. I look at the deltas, 21, 24. I like to play around the 30, 25 with Tesla. With other stocks like Apple and SPY and Qs and Facebook, I try to be around 40 or so, 35. But for Tesla and Netflix, I try and be on the lower end of the delta because it gives you more room to work with by a lower end. Plus, these are expensive. I mean, you're talking about $6 per contract, and again, it's times 100, so it's actually a $600 contract. And if you're trading, and just to do the calculation in front of you guys, if you're trading say 10 contracts, 600 times 10 is $6,000. If you're trading 30, like I do, you're trading $600 times 30, you're trading $18,000 at one time. but that also means you're controlling 100 shares per contract. So 100 shares on, so 30 contracts times 100, you're looking at 3,000 shares times a price of $600. For me to spend $18,000, I control $1.8 million worth of Tesla. Let that sink in. Almost $2 million worth of Tesla that I control. I can do whatever I want with. And I only had to spend $18,000 to do it. So it's really good. Now that's super expensive, and I can talk about SPY and Apple much more reasonably priced and everything. But for this one, I was talking about the trade that I made. So working with Tesla. So I find whatever one I want. So I find the one I got. Okay, cool. Let's just take this one for instance. I right click on it if you're using Thinkorswim. I drop all the way down, send to, and I already have my stuff already set up, but I send it to up here, which is red. That's yellow, that's green. Green is my longs, red is my shorts. It's just easier that way. It's just how I do it. So now I go and look. Now this is the actual call option right here that I chose. That was the 570 put option. My bad. 570 put option that is now in chart form. So now it has its own new identity, own new thing, and you're able to see a chart that actually shows the actual strike price. Even better, I have a DOM now. So now I don't have to go down here and click on it, wait for the little thing to pop up in Thinkorswim, and then once that comes up, then I choose the strike price that I want, and I click here, change the price, so on and so forth. It takes too much time. Literally, all I do is go in. I'm not going to do it because I don't want to buy anything. But literally, I hover it over here, whatever it is, and I click it. Boom! I have it set in tens because I'll do it 3 or 4 times depending on what I'm trading. If I want to trade Amazon, maybe I'm only going to do it once. If I'm trading Apple, I might do it. Might be trading 40 or 50 contracts at a time. So it just depends because they're cheaper, but they don't move as much. So you need to trade more contracts to get the value of Apple SPY Qs. Unlike equities, though, options cost commissions. I have a negotiated agreement with Thinkorswim, but I think if you sign up with them, I believe they charge 65 cents. I only pay 30 cents per contract, so it's half of the negotiated or half of the standard rate, but it still takes a toll. I mean, you're looking at, again, calculator wise, if you're trading 30 contracts times 0.30, you're looking at $9. Round trip, you're looking at $18. So $18 just to make the trade and close the trade. Still, so not that it's very expensive, but little expenses do add up. So you just got to be mindful of it. So in regard to the trade, once you have the trade on, again, once I enter the trade, bam, 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 I'm in the trade now. Cool. I go in there and put my stop right here. Boom, 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 immediately. You can already set up a bracket. It's called a bracket order. And once you enter a trade, it immediately sets the stop immediately. I don't have that on. I do everything manually in that sense, but you can do that. I have that in my Ninja Trader trading when I'm trading futures. I don't have it as a function right now, trading options. I don't really have a good reason. I just really haven't set it up, and I don't really think I need it at this very moment. But yeah, I mean, stuff moves so fast. Well, anyway, so if you enter a trade, and for instance, when I was trading, it was right around, let me look at the time. What time was it? It was around, looks like 10:14. So if you look around 10:14 area, 12:14, bam. Okay, cool. Let me zoom in a little bit over here. So 10:14, This particular option, if you bought one contract, would have cost you at 1014 somewhere in the vicinity of $3.80 and $3.40. So let's just say somewhere in the middle. Say $3.60 was the cost. So you buy one contract that costs you $360 to buy it. You have one contract now. Well, what happens after that? You set your stop. Now in Tesla's situation, I do have a bigger stop normally. Normally I'm right around the 20 to 40 cent area. Just depends on how it's moving or whatnot that particular day. But it's normally in between 20 and 40 cents. And so for every penny, it's $10 and everything. So now this particular trade at $3.60. So in the very next bar, it moved up as high as $4.10. Right there. So it's $4.10. So it's up 50 cents. In that regard, you just made 50 bucks. That quick. One bar, 2 minute charts, and it was just like that. You could have taken the trade right there and been done. But if you look, and I'll slide this one over right here. If you look, all that did in this particular one, it just dropped. It won't let me highlight because it's going to move the box. But it went from here to here. That's it. From here to here. And everything. So in one bar, that's all it moved. It went from 609 to 606, almost. It was about 607 and everything. So it was a $2 drop. So that particular $2 drop, in one bar on Tesla, made it all the way up. Where was it? Here. Made it all the way up here to 410. $50 right now. So if you traded 10 contracts, that would have cost you $360 per contract. So it would have been $3,600 to do 10 contracts. That would have been your investment. But that particular move would have made you $500 on just that move. Let's just say you close it out right there. Cool. Now, what happens if you held out to, say, $5? At $5, it's $1.40 move on the option. So that would $1.40 would have been worth $1,400. So it's just a big move on 10 contracts. That's why I trade options, because it's a very low investment. It's $3,600, and to invest in Tesla, and let me get the screen out of there so I can bring up a calculator for you guys, because it's all about the numbers. So 10 contracts, again, cost you 360, so times 10, you're at $3,600. All right, so now you're at $3,600. You control 10 contracts, but they're all multiplied by 100, so 10 times 100. So you control 1,000 shares at 600 bucks. So you control $600,000 worth of Tesla for $3,600. That's an amazing. Like, where else can you get that? Where else can you get that? But the leverage you can get on options is through the roof. The problem with it, though, is it moves exponentially. And that would be a lesson on a whole nother scale, how the delta changes on a daily thing. But just to put in perspective, to lower the sense, let's do Apple, just to look at Apple, to put it in to better terms. In Apple, let's say we picked, let's look at the open interest right here. We got 10,000 here, 8,000 here. Let's just say we took one that was close to at the money, but still out of the money and everything. Let's go. We'll send it to red. Cool. All right. So Apple, where is Apple at right now? All right, Apple's at $1.39 here. So early on, Apple was around $1. Early on, 9.52. And let me pull up Apple. Come on, move the screen. Here we go. Let's talk actually numbers. 9.54. It's actually 9.52. Thinkorswim. Oops, I want to do that. 9.52. All right, so let's zoom in here. 9.52. This is this bar right here. So Apple is trading around $123 and some change. Let's just say you got filled in this bar at $1. So now you bought this option for $1. Okay. So again, you're looking for it to go down and you're shorting Apple. So you buy it for $1, and let's say you buy 10 contracts. So one contract costs you $1 times 10 or times 100 shares is $100. You buy 10 of them, you're looking at $1,000. So $1,000 is what it costs you to control. Again, 10 contracts times 100. You're looking at 1,000 shares you control. 1,000 shares times 123 is $123,000 worth of Apple stock. That's the value of stock you can control. And you did it for $1,000. So you control over $100,000 for $1,000. That's amazing. Where else can you do that? It's less than 1% you've invested. So now what happens at this point? All right, cool. Well, you bought it at $1 and Apple went shooting down. And so let's say 124, and she shot down all the way down to 123.60 from, so almost $1, 80 cents. All the stock moved was 80 cents in that particular move. But let's just say you bought $1 and didn't buy it down here, but let's just say you bought it here. In that move right here, it went up to 123. And again, let's just take even numbers, like $1.20. So you made 20 cents per contract. So again, 20 cents on 10 contracts would have equaled $200. So you netted a profit of 20% of what you've invested. And let's say it went against you from $1, which it did. It went down from $1, so you bought it right here. And you bought it, and it just kept on going down. Okay, you're in Apple, my stop is normally around 15 cents. I never would have touched it. But let's just say it did. Okay. Let's just say it hit my stop and say my stop was there. Well, all right, you lost 10 cents on 10 contracts. Excuse me. 10 cents for that was $100. Times 10. So if you were doing it with one contract, you would have lost $10. 100 contracts, or I'm sorry, 10 contracts would have equaled $100. That's what you would have lost. So on 10 contracts, if you had a 15-cent stop, your stop would be $150. Okay, cool. Your exit's $150 if it did come back and hit it. But let's say it didn't, and it went up. Your profit was $200, which is more than your risk. Now, I would expect Apple to go much higher. Well, not as much as it used to. Before the split, Apple was awesome. Not so much anymore. It doesn't move with conviction anymore like it used to, unfortunately, when it went down to the $100 range. But, it'll be back in the 200s area, and it'll be moving again. But until then, that's when I'll probably end up trading it more often. But normally, I look for Apple to make a larger move, and again, let's zoom out a little bit so we can kind of see what we're talking about. And bam, it went all the way up to $1.60 something. Let's just say $1.60 for even numbers. So in this particular move, it moved 60 cents from $1 entry that you made. And again, we're talking apples to apples. That was around 1050. So around this area right here. So from here to here. So from there to there, you would have made $600 on 10 contracts on $1,000 invested. Okay. Well, let's put it into perspective. What would you have made if you bought the stock? Let's say you bought the stock, and let's just say in a perfect world, you had nothing at all to do. Let's just say you bought at the very highest to short the stock, and it's 124.48. So let's just say 124.50 for even numbers. And again, in a perfect world, let's just say that was 120. That's 122.83. So again, let's make it a little even. 122.50. We'll even give it an extra 30 cents, which it never even hit. So it went 124.50 so it made $2. I mean, really didn't, but we just for the math. So for $1,000, it moved. So you would have been able to buy 9 shares because it's a $123 stock. So times 9. Oh, you wouldn't have been able to buy 9. So you have to buy 8 shares. 123 times yeah, sorry, perfect. So it's just around $1,000 bucks. So you got 8 shares. 8 shares, and then you made $2 per share. 8 shares times 2, whopping $16 you just made. Doesn't that suck? $16 you would have made if you were just buying stock, because you bought 8 shares. It moved $2. So you made $2 per share. You made $16. If you traded options, you made $600. That's the point of options when you're day trading. That's the difference. That's why I trade options. That's why I don't trade equities. But you have to do it in very spread specific, good open interest, good volume. The power of options can take your trading to a whole new heights, but you have to know how to trade it. You have to know when to trade it and when not to trade it. So the difference with options, well, there's a lot of differences, but one of the other things that to be mindful of, options have their own market. You see, there's buys and sells too, just like the equity market does. It moves pretty close. Let me put a Apple call up here real quick so you can kind of compare apples to apples.
That's punny, comparing apples to apples on Apple.
On Apple, yeah. And all right, so all right, this is a bad one because of course I picked the one that didn't have a lot of interest. Let's move one that actually had a lot of volume. Here we go, 30,000 sold on this one. All right, so this is Apple's call option, and this is Apple's real equity chart. They move quite similar, but it's not 100% perfect. It doesn't move to the same exact extent, and I'm trying to find a good example for it, but okay, for instance, right here on this particular one, you see right here where this is lower than this, but over here, I don't have hotkeys on this chart because I don't draw on it, but this is higher than this, which is different than here and here. So you might get stopped out on an option when the price never moved that direction, because it's filling its own market over here. They correlate almost 95% matching up, but that 5% can knock you out of trades, good and bad. Sometimes it keeps you in trades when you should have been knocked out. Sometimes it knocks you out of trades that you shouldn't have been knocked out of. You have to deal with it. It's the way options are. They have their own market for trading. They mirror the market pretty well, but you just have to make close attention of what you're doing.
One thing I want to add to that too is I noticed this last year during the big sell-off. When the VIX is extremely high, that does really mess with the options market as well. when the volatility index is very high, that does make it a challenge in options from what I noticed last year.
Oh, absolutely. When the massive sell-off happened back late March of last year, option day trading was impossible because this same option that cost $1.61 down here, back in March, that thing could have been $10, $20.
With huge spreads.
Well, I'm not talking the spread. I'm just talking that particular option. And so you go from a 1 cent spread on Apple to a 30-cent spread on Apple, or a 50-cent spread on Apple, on the same exact thing you've always had a 1 cent spread on. It was untradeable. I physically could not trade options for almost a month when the sell-off was going on because the spreads were out of control. And I don't mind paying more for the option as long as the spreads stay the same, but the spreads were insane. I mean, absolutely nuts. I mean, I believe SPY had a spread of around 70 cents, and that's unheard of. You can almost look around all over SPY.
You're never going to see more of a spread than maybe like 5 cents.
Right. And just to open it up.
And the reason for that is that the SPY and the options are the most liquid, in my opinion. And when they're liquid and we have a lot of action, that's what's going to keep those spreads really nice and tight because you have a lot of supply and demand, which keeps those spreads really close to one another.
I mean, even on the most expensive ones, and you'll never trade over here. You'll never trade in this area. There's still 1879 to 1889. You know, they're actually the stock that one moved. But yeah, that's a 5 cent, 7 cent, 9 cent. I mean, it was massive. You were in March at the money where stuff is always 1 to 2 cents off, maybe 3 cents at the most, depending on the gap, just because the market maker hadn't changed it quick enough. You see 1, 2, 3 cents in March and April. You were seeing dollar differences. It was impossible to trade. It was impossible to trade my method. So I traded mostly futures. That was my background before I went into options, was I traded futures. And so I traded futures pretty much on the regular. And you can trade SPY in options, or you can trade the ES. So the ES on futures is the exact same thing as the S&P 500 or the SPY, except you trade it in futures, which is fine. So again, it's a completely different language than equity. It's a completely different language than options. Futures is a whole nother world. Again, it's one of those things that isn't regulated 100% great. It's perfectly legal, trading wise to trade it. The nice thing about trading futures instead of equity, your CPA will love you, because at the end of the day and the end of the year, if you've had 1 million trades, all you do is you get a 1099 that says, hey, you made or lost this much money. Whereas if you're day trading, you have to submit a spreadsheet that's a mile long. My CPA loves me. And
it's a love-hate relationship.
Yeah, exactly. I don't know. I think I pay for his mortgage. I'm not sure. But yeah, it's definitely advantageous and everything for tax purposes. And again, if you were looking at tax purposes, Josh, I don't even know if you know this. We never talked about it. Was what is it called? I don't trade it anymore. What's the more
CFDs?
The not the SPY, but the other one that's more expensive. It truly is the
SPY, yeah, the S&P 500, not the ETF, not the spider, but
not the ETF, right?
The actual SPY, right? That's like sitting around 4,000.
Yeah, do you remember what the ticker is?
I do not, but we could find that out real quick. Is it SPX?
Yes, thank you.
SPX, yeah, SPX. Yep, that's it.
So SPX, super expensive.
Look at those.
Super expensive. These options are massively expensive. Let me just get this back down to 14 so it's closer. Okay.
3,000.
Again, these are super expensive, but if you're talking tax purposes, I used to trade these. I traded them because if you trade the SPY, you get taxed as as capital gains tax on everything. The great thing about the SPX is it is split into two portions. Part of it is capital gains. The other part's taxed at your normal low tax rate. And it's actually split off into two different categories. And I can't remember the exact percentages. And I mean, you could quickly Google and say SPX tax treatment tax rate. 60%. So 60% is taxed at your normal tax rate, your long-term tax rate, and 40% is your short-term capital gain tax. So if you're looking to reduce your tax burden, that's where you trade. And it's a phenomenal thing if depending on how you're trading it. My model doesn't work because the gaps got too wide. So as you can see there, you have 30, 60, almost $1 gaps or so, 40 cents, 50 cents. So for me, it didn't work. It didn't work in my particular strategy. Maybe it works in yours. I'm not sure, but it did not work in mine. So that's why I ended up, I stopped trading it. But it's a phenomenal way to reduce tax implications. That's for sure. But yeah, no, it's
Good stuff, man.
Otherwise, I mean, there's just so much more you can go on or whatnot, but unfortunately, I got to run.
No, yeah, absolutely, man. And again, guys, give him a big round of applause. Thank him so much for taking time out of his day to jump on live and really just kind of explain, his approach, his strategy, and what he looks for when day trading options. And I know he has to jump off here, but I'm going to go ahead and close it all down with a little bit of a recap as I was taking some notes, again, just to make sure that you guys took everything in and make sure that we're answering any questions that you guys have as well. So again, thank you, Matt. We greatly appreciate your time. Awesome lesson, awesome stuff. We definitely all picked something up from this today. Even I did, trading the SPX and tax implications. I mean, really good stuff. Nothing but value bombs. Or I would do that sound effect, value bombs. But I don't want to hurt Matt's ears over there when I start yelling like I normally do. So again, man, really appreciate your time. And I know you got to take off, man. So I'll catch up with you later.
I appreciate it.
Absolutely.
Good coming on. Thanks for having me.
Yeah, absolutely. Until next time.
Absolutely.
All right, guys. So I do want to run through a few things real quick, okay? So I do want to do a quick little recap on what Mr. Matt was talking about to really just break this down and put it in more simple terms. Before we do that, let's go ahead and get our scanners back up. I do not know why we lost everything. And we're good. So did you guys learn something today? I'm sure you did. I'm sure you picked up something, which is amazing. So a couple key points that I noted is, again, when Matt's talking about what he's trading as far as options, right? He's not trading 100 to 200 to 300 different tickers. He's not, this stock is gapping up on news and on volume, right? Again, with equities, penny stocks, that's what we're looking for. We're looking for stocks that have a catalyst. We're looking for stocks that are up on news, that are up on volume, that are low floats when we're trading these penny stocks with equities, with shares. But when it comes to options, it's better to find a list of stocks, again, based on that criteria from Monday, that say trade on average $2 to $3 a day. That on average, have a $1 to $2 price point. That on average have a nice tight spread. Again, if we start looking at something like SPCE, what is that? Virgin Galactic, right? Just because it's moving up one day doesn't mean the option is going to be beneficial to trade. We really run into issues with implied volatility, right? Again, it's something that normally doesn't trade aggressively on options, but boom, it is trading aggressively on options. Do you not think that's going to increase the implied volatility? It definitely will. Those spreads are going to be a little wild. Let's say you're on the wrong side of the trade and it starts to flatline, and now you're losing money because you're getting an IV crush. So again, pick a selection of stocks that you would like to participate with when it comes to options. Again, Matt has about 10 to 20. Again, you can have 5. You can have 10. I know a lot of traders that have like 1 to 2 stocks that they trade all day, every day, options, because they're familiar with it. They know how it moves. They've identified their edge when it comes to trading that particular stock. So number one, pick a select few stocks and back test with those. Again, the S&P is probably the best one to start with, guys. And that's SPY, the S&P 500, okay? The spreads are tight. They're cheap. They have 3 expiration dates per week, right? So they move quick. They're very, cost effective. And the spreads are always about 1 to 2 pennies. So that is a great one to add to your watch list for options. Again, he trades Apple, Facebook, Tesla, Disney, JP Morgan, right? But you have to do your due diligence and back test and paper trade. Again, one thing that Matt said as well is he doesn't use indicators. He's not using an RSI. He's not using Fibonacci's. He's not using the VWAP and the 90 EMA. His strategy, his edge, right, that works for him is completely different than what mine is. But we're both still profitable at the end of the day. So that's the stress factor is, again, mirror trading doesn't work. Me teaching you what just my edge is doesn't work. I have to be able to sit here and teach you everything so you can back test these and determine what your edge is. Like Matt, again, he's looking at these trend lines, right? Trend lines, making his entries, wedge formations, really everything is support, resistance, and trends. I love using the VWAP and the 9 EMA and Fibonacci's and RSI. That's what works for me. That's not what works for Matt. So again, determine your edge, right? And that's really what it comes down to with paper trading, right? Matt paper traded for a year, guys. That's a long time as far as being disciplined and patient with making sure that he has his strategy in place, that he has enough data that he can look at and say, this is where I'm successful, this is where I'm not. Again, it takes a lot of discipline and a lot of patience to be able to paper trade for a year and see what you could have made real money. But it is worth it. It is so important to understand what your edge is, which stocks you want to trade, what delta you want to look at as well, right? And again, when we talk delta, that's how you're going to determine your potential risk and your potential reward when it comes to options. So again, what are some key things you need to be focused on when looking at an options chain, right? What does Matt look at? So he's coming in and right off the bat, Matt is looking at the open interest, right? We want to make sure that there's enough contracts out there for us to get in and get out of, right? Again, if you find one that has 2 on the open interest and you want to buy 10 contracts, you're not going to be filled immediately on those 10 contracts. You will be filled on 2 and you will have to sit on standby for the other 8. So again, open interest is very, very important, all right? Volume as well. You want to make sure you're actually where the other traders are at. Where is the most volume? Not only is, you know that there's activity and there's volume there, but that's going to help tighten up the spread. We got to think of, compare it to penny stocks. When you have a penny stock that is literally trading no volume, right? There's no liquidity. There's no buyers and sellers, right? What happens between the bid and the ask? It gets farther and farther and farther away from one another. The same thing with an option contract. Not all the time, but it's a good rule of thumb is when you have light volume, low volume, those spreads can definitely open on up. And we've seen those on like the SPCE contracts, right? When we were looking yesterday, Virgin Galactic, the spreads were pretty large and there just wasn't a substantial amount of volume. So again, open interest, make sure you can get in and out. Volume, make sure that there's actually activity there. That's going to assist with keeping those spreads nice and tight, all right? And again, the rule of thumb is no more than 5% on your spread. You may have 10%, you may have 2%. My rule of thumb is 5% between the bid and the ask. If it's greater than 5%, I will not trade that options contract. And then lastly, delta. Again, Matt's approach is on certain stocks finding something with a 25 to 30 delta. But then on other stocks, depending on how volatile it is, depending on how much it moves, he may take a step back, right? He was saying like maybe a 40 to 45 delta on Apple, right? Because it doesn't move as quick or as volatile, so where I can still manage my risk appropriately. But now if you go to Tesla, and Tesla moves $5 in 1 minute, if you are in a 50 delta, it gets a little bit trickier and harder to actually manage your risk. That's why he's stepping back to maybe like a 20 or a 25 delta, because again, that delta represents every dollar move that the stock goes up or that the stock comes down. So again, sometimes he takes a step back, maybe cuts that delta in half on certain stocks because of the volatility and how quick it moves, just to be able to manage his risk appropriately. Number 3, use hard stops, right? It is very tricky to come in here to go ahead and click what you want to buy, go ahead and change your size. If you want to do market, and then send it. Then you have to go back in and do a hard stop. And it's going to take you 5 to 10 seconds to complete an order to get it in the system, and then another 10 seconds to put a hard stop in the system, right? That 10 seconds could be a game changer on, do you need to get stopped out? Is the trade going against you? Correct? Or when are you getting into the trade? By the time you type it up and you hit send and you're ordering all this stuff, you could miss the trade, and now you feel like you're going to be chasing it because now you're going to market order in, get in high, and not have a disciplined plan. So how do we actually make it easier to trade options? Well, it's very, very easy. So let's say you want to buy a put on the SPY. Again, you pick which one you want. Hypothetically, let's say we're picking a 405 strike, right? We're going to go ahead and right click this, and we're going to send this to blue, for example. So now I'm no longer looking at the SPY's chart. I'm actually looking at that set strike, right? And that set strike is a 405 put. So again, what's the beauty about this? Again, you have its own chart that you can look at. Not only that, but now you can actually use your active trader, right? You can actually come in here and immediately, boom, buy, boom, sell, because you have an auto send feature. It skips the order confirmation part of buying options. What can you do right away? Once you buy it, you can come in here and put a stop in. So boom, you're in, boom, you got to stop just like that. 2 seconds, you're good to go, versus 20 to 30 seconds doing it the other way, right? So that is a really cool trick with TD Ameritrade on how you guys can actually use the active trader ladder. And it makes it so much easier and so much more efficient to actually trade these options in a very quick fashion. Because again, he showed you a few examples. In 1 2-minute bar on Tesla, that was already up $1, 50 cents, whatever the case was. That's a big, quick move in 2 minutes. Imagine a move on Tesla happening in 30 seconds. You're not going to have enough time to come in here and readjust everything. But if you're using a ladder, right? If you're using a ladder, you're going to be able to go boom, 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 right? Quickly change your quantity. It's very easy. It's very simple. So again, you just go in here to your options chain, and once you identify which one you want to trade, simply right click it and actually send it to one of your charts so you can use the active trader. Okay? So always put a hard stop in the system, guys. So when you're looking at a trade, let's assess, let's say you're going to risk, let's use this for an example, all right? Let's say you're going to trade the 405 or the 404 put, right? You can assess your risk, and that's going to be based on the delta as well. So then once you assess the risk, you assess your potential reward, the type of setup that you're looking at, you go ahead and put that hard stop in the system. That is the price in which you said, I'm walking away. And if you get stopped out, you should not exceed that initial stop, right? If you say, hey, I'm going to buy one contract with a 30 delta, and if the stock comes down 50 cents, right, I'll lose half the delta, which is 15 cents. So right then and there, you know what your stop is. Boom, send it over, blue, come in here, buy it, and then right away you come down 15 cents and put a hard stop in. So if SPY, the actual SPY, comes down 50 cents, this will most likely come down 15 cents on the options contract if the delta's 30. You guys catching on and following along? And go ahead and put that hard stop in the system and then take profit as needed at your profit targets. Okay, guys? So always put a hard stop in the system and never, ever, ever take it off or take it lower. The only time you move a stop loss, whether you're trading futures, options, equities, penny stocks, the only time you move a stop loss is if it's getting closer to your cost basis to reduce your risk. It never goes further away. All right, and lastly, options just provide bigger percentage returns with a lot less capital, right? A lot of leverage. He really put that in perspective. For every contract you buy, you're controlling 100 shares. So if you bought, once again, one contract of the SPY, and the SPY right now is at $406, right? 406 times 100 shares. That is $40,000 worth of SPY that you control. But here, if you buy one contract of the SPY, right, it's only going to cost you 40 bucks. It's going to cost you $40 to control 100 shares, which equates to roughly $40,000 worth of SPY. All right, so the beautiful thing about options is, again, it can be risky. Let's be honest. Options can be risky if you do not know what you're doing. But once you've paper traded, once you've established your edge, once you have proven consistency, you get that nice amount of leverage. For every contract, you control 100 shares of the underlying stock. right? Which provides bigger returns. And his example was a beautiful example. If you would have shorted that Apple, it was his example on Apple. If you would have shorted Apple at that $1,000 that you had in your account, you would have bought 8 shares. You would have made, what was it? 9 shares. I'm sorry. You would have made $18 of profit on that, that $2 move. If you would have purchased a put option and invested the same $1,000 on that same exact move, you would have made $600 of profit. That is a 60% return. When Apple, all it moved was maybe 1%, but you're getting 60% on the option. So again, there's a lot of great opportunity and so much potential and so much opportunity, again, to trade options, to really leverage your capital, to really make some big time money. Again, though, you have to be smart. You have to be disciplined. You have to back test and paper trade. And then once you go live, I don't care if you paper traded month 1 with 1 contract, month 2 with 2 contracts, and over the course of your year of paper trading, you finally got to 30 contracts. When you go live, you need to repeat your cycle of 1 contract, 2, 3, 4, 5, because things do change from paper to real money. Your emotions change. Like Matt said, your heart starts beating different. You start overthinking things. You get analysis paralysis, right? You start second guessing. Things do change when you're really investing real money. That's why you need to reset and start with 1 contract with your strategy. And then go up to 2 and 3 and slowly progress. And then in no time, guys, again, you don't have to paper trade for a year. That was how long Matt did. You may find great consistency in 3 months. You may have some solid data and some great, just a track record of success. So you're like 3 months in, I'm ready to go. Maybe 6 months. Again, everybody's different, right? Some traders may take 3 years. Some may take 3 months. But again, you always start with trying this on a paper account and treating it like it's real money, not fugazi money, not a million contracts and you make $1 million, right? You got to treat it like it's real. So actually set your account with a realistic amount of capital and actually start there and get the hang of options, right? Buy them, sell them, put stops in, try different deltas, right? Really just practice with these options and you're going to get the hang of it. But really what we're here to do is provide you with the knowledge that you need to take the next step to start paper trading. And over the last 3 days, we have dropped so much value, so much information, guys, to where now you can take all of this and you know how to get started. You know how to get going. You know some tips and tricks and some techniques and strategies from Matt on how he trades options. Maybe you can take the techniques that we apply with penny stocks and apply it to options to see if that works for you, right? You have enough information now that you can actually take that next step forward, start applying what you're learning, and start working towards results and success. All right, guys. So again, options are a completely different language than equities and futures, right? Like Matt said, it took him a year before he really understood a lot of these terms and terminology. It does seem confusing. It can seem intimidating, but that's why we're here, is to help you every step along the way, to answer all of your questions, to make sure that we can work with you one-on-one if that's what you need. Again, screw the Q&A session. Let's work with you guys one-on-one and push that to the team so we can all learn together. That is the best value that you're going to get anywhere. No one else will even recommend hosting a live one-on-one session inside a chat. And that's where you're going to get that extra added bit of help that you need to continue taking your next step forward and becoming a consistent and profitable trader. So guys, once again, thank you so much, Matt, for taking the time out of your day to walk us through this. If you guys do have any questions, comments, or concerns, if you're confused, you want me to reiterate a few things and cover a few things again, I am definitely okay with doing that. But definitely should have been taking notes, guys, right? And if you have any questions, you should have been writing those questions down so you can ask those to get a proper answer so you can start moving forward.